Job market has cooled off sufficiently, and inflation, as I just argued, I think properly measured, is at the Fed's target or beyond the Fed's target. It looks like we're going to make our way through without a problem, without something breaking in the economy. Now, having said that, if they don't cut in September, that could be an issue.
Look, I think he went out of his way to say it's not a foregone conclusion, but I also think, frankly, it's far more likely than not. A couple of things struck me in the press conference. One was the revelation that some of the members had actually discussed a rate cut at this meeting, which for me was a bit of a surprise. And secondly, Powell did say that the economy is roughly in balance. And the logic of an economy that's roughly in balance, not too hot, not too cold, suggests that you don't really need to have short-term interest rates in restrictive territory. So I think the logic of the argument tends to lean much more towards a higher probability of a cut than maybe Chair Powell was willing to admit yesterday.
Let's now get to the final update on the global markets. European markets closed lower on Thursday as investors processed a raft of central bank action and fresh US economic data. All major regional bourses and most sectors finished in negative territory. The pan-European stock 600 index provisionally closed over 1% lower, while the Bank of England cut interest rates for the first time in over 4 years, taking the key rate to 5% from a 16-year high of 5.25%. The Monetary Policy Committee voted for a cut with a 5-4 majority. And that's the global market action that we have. But how will all of these overnight cues impact our own markets? We have our research team joining in with how the trade setup looks like, the stocks you need to keep an eye out for, and of course the FNO setup as well. First up, Vivek joins in to get all the market cues you need to watch out for. Vivek, good morning. It does not seem to be a pretty looking picture.
Absolutely not. And when you're talking about the screen, it's red all across. Like you mentioned, at the start of the show, how the kind of weak handover we've received, especially from global markets. Today, even the Asian markets, GIFT Nifty, all of them are indicating quite a deep gash across our own markets. Overnight, all US markets ended in the red. Along with that, even post-markets, names like Intel and Amazon fell quite sharply on the back of muted results. Oil prices fell. Brent crude almost down over 1.5% yesterday, now hovering a little lower than the $80 a barrel mark. Indian markets yesterday, remember, Nifty hit the much awaited level of 25,000, but after that we did see some selling pressure. What was a little bit more worrying was the fact that the breadth was negative. In fact, advanced decline ratio was 1:2 in favor of the decline, and broader end of the markets after a while actually underperformed the benchmark indices. But quite a lot to keep on the plate today, given the fact that there will be quite a lot of earnings reactions to numbers that came in post-market hours yesterday, top amongst them being Tata Motors and ITC. Results today, quite a lot of them: Britannia, Titan, Hinzink, UPL, LIC Housing. Also remember, markets will react to auto sales that came post-market hours yesterday as well. Eicher, Hero Moto, and auto sales overall this time around has been quite muted compared to what the street was anticipating. Asian markets, GIFT Nifty, especially Japan's Nikkei, all indicating quite a deep gash, gap down for our own markets today.
Now the gap down has increased to over 200 points now. Vivek, thanks a lot for that. Over to Vamakshi. List out the stocks you need to watch out for this morning. Vamakshi, good morning.
Well, good morning, Hormaz. Let me first start off with ITC. The company reported volume growth of 2% as compared to expectations of 2 to 3%, according to sources. Revenue came in above estimates. EBITDA margin, however, was lower than estimates due to lower paper and agri margins. Net profit was almost flat at 4,917 odd crores. Tata Motors also reported its numbers stronger than expected. Guidance, however, was cautious. They have highlighted that JLR could likely witness constrained production in the second as well as the third quarter. The board has gone ahead and approved demerger of the passenger car and CV business as separate listed companies, and this will be completed over the next 12 to 15 months. Let's also look at some auto sales numbers that came in for the month of July. First up is Maruti Suzuki. Total sales stood at 1.75 lakh. As this is lower than Nomura's estimates. Exports picked up by almost 8.1%, but total domestic sales were down 5.3%. Eicher Motors, the next one on our radar, Royal Enfield sales were down nearly 8% to 67,265 units. This is much lower than the Nomura estimates. VECE CV sales were up almost 12.7%, and this too came in below Nomura's expectations. Hero MotoCorp reported a downtick of almost 5.4% in its sales at 3.7 lakh units. This is again lower than what Nomura was expecting. Symphony is the next one we will be focusing on. They will be considering a buyback on August 6th. GHCL has signed a 30-year lease agreement for 6,450 hectares of land for salt production in Kutch, Gujarat, and this will cater to the salt requirement for upcoming soda ash greenfield project at Kutch. Netweb will also be in focus. Sources suggest that Sanjay Lodha, Naveen Lodha, Vivek Lodha and Neeraj Lodha are likely to sell 20.54 lakh shares of the company via block deals. The floor price for the deal is at 2,180 per share and the offer size is pegged at 448 crores. And lastly, let's focus on Morpin Labs. Sources suggest that QIP will be launched. The issue size is up to 200 crores and the equity on offer is 3.68 crore shares and the indicative price is at 54.37 per share.
Plenty of stocks as always. Vamakshi, thanks a lot for that. Over to Sudarshan now, joining in with cues from the F&O space. Sudarshan, good morning. Looks like a gap down, but what's the F&O setup looking like?
Morning, Rahman. So yesterday we saw that Nifty held on to the levels above 25,000, but it looks like it was a short stay there, as after weak global cues, GIFT Nifty is indicating a gap down start for our market today, and currently GIFT Nifty is down more than 200 points. But if you look at the flows, it's not looking that bad. In the cash market, FIs bought shares of more than rupees 2,000 crore, while the sell figure by DIs was just rupees 340 crore. Even in the index futures, FIs bought shares of almost rupees 1,400 crore and has added long contracts of more than 18,000 and at the same time have cut short positions by almost 3,600, and this takes long exposure to almost 66% with total net long contracts to 1.66 lakhs. In the options, we saw strategy at play at 25,000. 25,000 call, we saw addition of more than 25 lakh shares with a premium at 148, and on the put side, 25,000 strike, we saw addition of 25 lakh shares with a premium of 154. This brings us to resistance and support levels for Nifty. Resistance is now seen somewhere around 25,100 and support remains around 24,850. In the stocks in focus, there are 4 new entrants in the F&O band. Those are Birlasoft, GNFC, India Mart and RBL Bank.
Interesting, Sudarshan. Thanks a lot for that update from the F&O space. But time for a short break here on Power Breakfast. Up next, we get you an exclusive story on sovereign gold bonds. Stay tuned, back on the other side.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBCTV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
Back with us here on Power Breakfast, and before we get to our exclusive story focusing on the primary markets first, India's leading electric vehicle company is all set for its IPO launch today. The Ola Electric IPO will remain open for bidding till the 6th of August, and the company also plans to raise about 6,146 crore rupees through the IPO. The price band has been fixed between 72 to 76 rupees a share, and the company has raised 2,763 crore rupees from anchor investors, which include the likes of SBI Mutual Fund, HDFC Mutual Fund, Nippon Life, HDFC Life Insurance, among other investors. And now here is the CNBCTV18 exclusive, as CNBCTV18 learns that the government may soon take a decision on whether to continue or discontinue the current sovereign gold bond scheme. Now, sources say that this matter is likely to be taken up in the month of September. Sapna Das is joining us with more. Sapna, what are your sources telling you?
Well, the expectation certainly is not looking extremely bright in terms of the scheme continuing, because as we have been pointing out earlier, also there are fiscal costs that the government has to bear on this scheme right now, given the fact the way the metal prices have rallied, gold prices have rallied, and plus there is a lot of tax rebate under the scheme. It also carries a 2.5% annual interest, so to speak. So, it's quite likely that a full review will be taken up in September, when the H2 borrowing calendar is decided along with the Reserve Bank of India, and a decision will be taken whether to continue or not continue. So, if the government and RBI decide not to continue with the sovereign gold bond scheme, what it means is that there won't be any further issuances. That's one. Now, the second element that we also need to keep in mind is that on two fronts the government is pretty uncomfortable. One, of course, that is one of the most expensive borrowing tools for them in terms of financing the deficit. And also some clarification coming in that this is more of an investment scheme and not a social security scheme, say like the small savings where you have a PPF or a Sukanya Samriddhi, where the government is bound to make good whatever money that is coming in, that needs to be paid at a certain interest rate, along with some tax incentives, at least one or two of the schemes. So that's the second rationale. Third, of course, as of now, we are given to understand that there is no alternative on the table to the SGB, so to speak. But of course, a call will first have to be taken, whether it's to be discontinued or whether it's to be continued at all or not. Now, 18,500 crores is what the government has penciled in as tentative borrowings from the SGB. Now, in case there are no other fresh issuances, if the scheme does not continue, it may be just possible that this borrowing will not happen. So that could be the other likelihood. We need to keep all of this in mind, and it's going to be a conscious call between the RBI and the Government of India.
Sapna, thanks a lot for that update. We'll keep an eye out on that. Time for a short break. Up next, we get you cues from the commodities market. Stay tuned. Back on the other side.
"25 years of excellence and unparalleled growth."
CNBC TV18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and cnbctv18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBCTV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
Welcome back, and it's time to say welcome back to Manisha Gupta as well, who is joining in with cues from the commodity space. Manisha, good morning. What are you picking up?
Harmal, thank you for that. I'll start with the crude oil prices, where we are seeing the prices headed for a fourth weekly decline. This is the longest losing streak since December 2023. Fuel demand concerns, weak manufacturing data that we've seen come in across globe, whether it has been US, European Union and most parts of Asia, really seems to be weighing onto the crude oil prices. So while we are just about holding $80 for the Brent markets do believe that with the kind of demand concerns that we have, even as we do have supply concerns, it still does look near-term bearish for the crude oil prices. It's a similar scenario for the metal prices continuing. Copper has declined nearly 3% overnight. Silver fell by 1.5%. The China stimulus is still awaited on a larger scale, on a more consistent manner for the industry and construction as sectors. Until you see that happen, we will continue to see further support in prices. But there is one thing that the street will watch out for today, and that is the U.S. non-farm payroll data. That would give you a further direction until the September Fed meeting, while, of course, markets have priced in 100% expectation of a cut in taxes in the interest rates by 25 basis points. So that is something that is already factored in by markets right now, but today's data will give you further clarity for that.
Manisha, thanks a lot for that. Indeed, all eyes will be on the non-farm payrolls data later this evening. Now on to updates from the landslide-stricken district in Kerala. Rescue efforts in Wayanad continue as nearly 200 people are still reported missing. Now close to 300 deaths have been reported so far. The Chief Minister of Kerala has said that the numbers could go even higher. The leader of the opposition, Rahul Gandhi, visited the worst affected areas of the landslide last evening and has promised support for those affected. Meanwhile, the IMD has predicted heavy rains for another 2 days in the district. And moving on to updates from the Paris Olympics, 28-year-old Swapnil Kusale bagged India's third medal by clinching the first ever Olympic bronze in the 50-meter rifle shooting finals. Indians' men hockey team, having already secured their quarterfinal spot, lost against Belgium in their pool match. Meanwhile, Manu Bhaker, who won 2 bronze medals at the Paris Olympics, will compete in the women's 25-meter pistol qualification today. And rising shuttler Lakshya Sen will battle it out at the singles quarterfinals later in the day. And with that, it's a wrap on this edition of Power Breakfast from me and the team that put this show together. Thank you so much for watching. Bazaar Morning Call takes the action forward.
भुंतर पार्वती और जिया संगम पे हो, जहाँ पर आप देखते हैं कि ये जो रौद्र रूप व्यास और पार्वती नदी का यहाँ पर उफान पर है। हालांकि अब जो है थोड़ा सा पानी कम हुआ है, लेकिन यहाँ पर जो व्यास पार्वती नदी के किनारे जो ये भवन था, निर्माणाधीन भवन है, उसको जो है भारी नुकसान पहुँचा है। जहाँ पर आप देखते हैं कि ये जो भवन का एक तरफ का हिस्सा जो है वो पूरी तरह से क्षतिग्रस्त हो गया है और इस पूरे भवन को जो है नुकसान इससे पहुँचा है। इसके साथ साथ आप देखते हैं कि यहाँ पर जो है बूंदर के पास जिस तरह से यहाँ पर सुबह के समय जो ये बाढ़ का जो मलबा और जो गाद है वो यहाँ पर सड़क तक पहुँच गया था, जहाँ पर सड़कों में आप देखते हैं कि यहाँ पर भी मिट्टी और गाद जो है पूरी तरह से भर गई है। और सुबह के समय यहाँ पर बड़ी संख्या में जिस तरह से लोग जो है यहाँ से प्रशासन की तरफ से लोगों को अलर्ट किया गया था कि लोग जो है वो अपने सुरक्षित जगह पर जाए, क्योंकि जिस तरह से मलाना डैम जो फटने के बाद पार्वती नदी में जो रौद्र रूप था, जिस तरह से भारी बाढ़ जो है यहाँ बाढ़ स्थिति यहाँ पर उत्पन्न हुई थी, चाहे वो जिया गाँव की बात करें या फिर बूंदर के आसपास की बात करें, तो इस सड़क तक जो है पानी बह गया था। आप देखते हैं कि यहाँ पर भी जो है मिट्टी और गाद भरी पड़ी है।
We've always grown ahead of the market, Rima. And when the market was growing at 30% 2-3 years ago, we were growing at 50%. And last year, when the market, we feel, grew probably like high single digits or low double digits, we were higher than that also. But at the same time, I think it is important to note that this is a business which has very high operating leverage. So even though that the revenues grew 15%, the PAT doubled in a year. And that demonstrates the strength of the product and the high margin nature of the business. So even going forward, we anticipate that as revenues grow, the profit should grow almost disproportionately with revenue growth.
So to your mind, what are the steady state operating margins?
Most SaaS companies in this space tend to operate around 25-30% margins at steady, EBITDA margins at steady state. We do anticipate at some point we'll also get there. However, it is important that we are taking a cue from your earlier question to Kapil. We are still in the very early days of e-commerce in India. I remember 10 years ago, when I started my journey in e-commerce, people used to say nobody will buy anything online. Then they started buying phones. Then they said, oh, but they will not buy apparel online because, the fit is important. Then people started buying apparel. Then they said, but they will not buy shoes for sure. And then people started buying shoes, and then beauty, and then pharmacy products, and then, even grocery and food, everything. So we have always been surprised about how much growth there is left in e-commerce in India. And hence, given Unicommerce is essentially an index to the e-commerce growth in the market, where as shipments of e-commerce grow in India, e-commerce volumes will also grow. And Unicommerce volumes will also grow, and Unicommerce revenues will also grow, and by corollary, Unicommerce profit should also grow.
Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBCTV18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV18 Motilal Oswal Budget Headquarters.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBCTV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning here, and we're coming to you live as always from the CNBC TV18 Motilal Oswal studios. It's shades of red, slight red, deep dark red across the Asian screen, across sort of overnight US markets as well. Will the market here continue to be Teflon coated like it has? Or will it also finally start to show some cracks? That's the question we're going to try and decipher over the next 1.5 hours or so. I'm Prashant. With me, my colleagues, Sonia and Nigel. Guys, good morning.
Hi, good morning, Prashant.
Morning.
Good morning, Nigel. And if you still have that sort of hangover of the 25,000 party, right, on the market. So big milestones hit yesterday. But yes, today it looks like it's going to be a tough start.
It's going to be a freaky Friday, right? Because the global markets, all of them down. And let's see whether or not the real bull will show up here, because that's been the case.
That has been the case. And, we've been saying that sentiment across the world has started to crack, except here. So I think today, in that sense, becomes a bit of a test whether that can continue in a similar kind of fashion, right? Or will we need to acknowledge at least what's happening around the world as well? So let's just begin with what happened last night, because I think that's essentially the most relevant point. US markets, complete reversal of what we saw on Wednesday. I mean, Wednesday, after the Fed decision day, basically, the Nasdaq ended about 3% higher, and the S&P was up 1.5%. Take a look at the reversals. And the Russell 2000, the small cap index, that was down about 3.25% as well. So this is, the change from last night. This is what most of Asia is reacting to, what is trading right now. Now, what caused this is the sharp deterioration in US labor market data. Now, and this came out, this was the first data point which came. So if you look at the ISM data, the employment subcomponent, this is ISM manufacturing, the employment component fell to 43.3. It fell some almost 6 handles. It's down to 2020 lows. And that is worrying. That is a sharp contraction. And by the way, before 2020, guess when was the low? That was 2009. So both are kind of, points in time when the economy is cratered and there was markets were looking very, very precarious as well. And that is the reason why markets sort of stood up and took notice of this more than anything else. Now, US initial jobless claims data also came. This was after, and that was also much higher than expected at almost about 250,000. The big monthly jobs data will come out tonight. So the data hits us right around the time US markets will start to trade. And because we've had such weak labor market data, I think US markets and global markets will pay particular attention to this. Markets have responded, right? Yields are down below 4% now. So 3.97 after the 6 basis point fall last night. Dollar index actually firmed up a little bit to about 104.34. It was looking like it would go below 104. But the point is, yields falling essentially, and the way it fell it's on the back of the worries that maybe the consensus, which is that we will see a very nice soft landing in the US, may not be all that given. Things can change over the next couple of months, and data will give us more. So that's the reason why risk aversion led dollar index higher. So that's essentially what happened. Now, oil prices, they'd seen about a 3% pop on geopolitical concerns. They fell back a little bit, about $80, so not very much happening there. Which brings us to the overall picture as far as the Indian scene is concerned. Now, we yesterday managed to close above the 25,000 level. Not a very convincing close, marginally above, 10 points above the 25,000 level, but it was a close nevertheless. We got to look at supports first. The 40-hourly exponential is about 24,846. It'll be lovely if the market kind of goes down to those levels. From there, there is some buying which starts to emerge. And I think that's the most relevant, 150 odd points away from where we left off. That's the most relevant support. The 20-day, of course, is way below, which is at about 24,567. About 24,600 is around where the next support levels comes in. Now, Bank Nifty, by the way, the Nifty Bank has spent all of the last 4 days 3 days within Monday's trading band, within Monday, between Monday's high and Monday's low. In that sense, I mean, the immediate levels become the high and the low for Monday. So 51,186 is the low on Monday. That becomes, I mean, the first level for the Nifty Bank, which is important. And the high is 52,340. So that's the range, I mean, and especially on the support, which is more relevant. And of course, below it, you are going to look at the swing lows, etc., on the Nifty Bank, which is also a recent level, which is 50,438. So after 51,186, 50,438 becomes the next sort of swing low support, which will kick in as well. GIFT Nifty will come up on your screen more often than not on bad global cues. The market here has taken note for an hour or 1.5 hours, maybe not even that, and then the market comes right back up. It's been a complete outlier. But will that be once again the same? I mean, I think the better thing to do is not to preempt it and let the market tell you what it wants to do. It'll give you, the screen will show you, and better to follow it because flows have so far overwhelmed everything else. Strong domestic flows have so far overwhelmed everything else. But we've also not had a situation in global markets where, people are starting to question whether, people have started to question the consensus, whether it is going to be a soft landing or now perhaps a hard landing. We don't know. It's too early. Things may change. 200 points lower on the GIFT Nifty on your screen. Sonia.
Absolutely. And I think the most important question is whether the dips get bought, right? Because this is a market that has been so strong for the last many weeks and months. We haven't got any major correction. And now will the dips get bought is the question. But there was a big sell-off overnight in Wall Street, and there are now recessionary fears as well after the recent economic data that came out. So that has sort of, got all the markets nervous. Asia this morning is also under a lot of pressure. The last time I checked, Japan was down almost 5%. But I'm looking at certain stocks this morning that could perhaps buck the trend. And maybe, if there is a correction and if you're looking for opportunities, there's a lot of good news as well in individual names. Zomato, of course, is one of them. So I'm watching that again this morning. Terrific numbers coming through from Blinkit. Big turnaround story over there. Blinkit has turned EBIT positive, and a lot of brokerages have raised their target prices on Zomato as well. Nomura has raised it to 280, Jefferies has raised it to 275. Blinkit, by the way, is now EBIT positive of 43 crores versus a loss of 100 crores same time last year. So that's the big stock I'm watching once again today. And in the auto space, Tata Motors, the results beat street estimates. Brokerages have raised their target prices on the stock as well. The board has approved the demerger of the passenger cars and the CV business. But more importantly, the commentary that Tata Motors gave out was a bit on the weaker side. They said that there are some headwinds in China and Europe. Just keep that in mind. But otherwise, good set of numbers coming through. The other auto companies that came out with their sales numbers have disappointed. So both Royal Enfield and Hero Moto have shown a degrowth in sales, indications that the two-wheeler space is slightly under pressure. So you'd want to keep that in mind. And Ola, the IPO opens today. We have spoken ad nauseum about the kind of risks that there is, the kind of positives that Ola sees. But this is India's largest electric two-wheeler manufacturer that will be hitting the Lal Street. This is going to assume quite a bit of interest as well. But getting back to the markets, looks like it's going to be a tough start.
Well, it's going to be a test for the bulls in today's trading session because the Asian markets are under pressure. You have the US markets as well that ended sharply lower. So let's see whether or not the bulls, they can fight back. And that's been really the case. You've been seeing that buy on dips. So today, that's going to be tested. Well, let's do a hygiene check with regard to what the FIs did and what about the clients. Well, not too much, actually. The FIs, they continue to remain net long. So on a day-to-day basis, well, 20,000 contracts is what they added on the long side on index futures, while the client side, they've added some mild shorts as well. Remember, at the start of the series, it was, only around a few thousand odd. That's gradually moved up to around 90,000 short contracts. So the clients are net short. Not very, very aggressively. In the last contract we saw, in fact, it was more than 2 lakhs as well. So that's how the FIs and the clients are positioned. Let's look at the options data because that's going to be crucial. We have the 25,000 call as well as put. Both of them were fairly active. You put them together, put the premium together, you could pocket close to around 300 rupees. It appears as a short straddle that's at play out here. One of the strategies that are under play. That you write both those two strikes and you pocket the premium. So going by that, the premium you pocket is around 300 rupees. You add 300 rupees and you deduct 300 rupees from around the 25,000 odd mark, which gives you the 24,700, extremely important on the downside. And on the downside, the 24,500 to around 24,700, that becomes a crucial zone where the bulls will want to defend. The 20 DMA as well is in that vicinity, and some of that should come up for you on the screen. So the 20 DMA on the Nifty as well, that's going to be important. That comes in at around 24,550 odd. The Nifty Bank, that's pat in the middle of both those two strikes, the 20 as well as the 50 DMA. And one positive is all of this week, the Nifty Bank has been making higher lows. So that's one data point that I managed to pull up as well. Well, yeah, that's the data point that we're talking about. Well, let's focus on two banking names. One is SBI. I don't know what the markets are sensing. It comes out with its set of numbers tomorrow. But yesterday, there was a sharp fall, particularly towards the end of trade. So SBI is a stock that you'll want to track. But HDFC Bank, that came back to life yesterday. It took support at around the 20 DMA. And the bulls could turn to HDFC Bank, just going by the solid close that we had. The 20 DMA is at around 1,620 approximately. A few more stocks that I'm looking at. Some of the stocks have moved into the F&O band. So just keeping an eye out on a few of them. Birlasoft, GNFC, you have India Mart as well as RBL Bank. So the buy on dips is going to be tested. Well, that's been the case. So let's see whether it plays out yet again.
Okay, buy on dips. Let's see. The market has been waiting, patiently for a big dip for many, many weeks and months now. Hopefully, if this time it comes around, maybe, the retail will get that opportunity to buy. But on the equities front, you have Chris Wood of Jefferies, who says that greed and fear repeats the point that geopolitics remains the biggest near-term risk to global financial markets. He says because wars are intrinsically inflationary, geopolitics poses a much greater longer-term risk to the government bonds than to equities.
Okay, we have Lakshmanan V of Federal Bank who's weighing in, and the yen, he says the Japanese yen saw huge volatility with the Bank of Japan raising its benchmark interest rates to 0.25%. He says the FOMC held interest rates, citing greater progress towards lower inflation and likelihood of a September rate cut. Euro saw sharp sell-off following dollar strengthening post-FOMC outcome. He says the rupee he's expecting the dollar USD INR to trade between 83.5 to 83.9 to the dollar.
Okay, and on the bonds, Lakshmanan says the government bond yields traded lower, tracking a fall in the US peers after the Federal Reserve hinted that its rate easing cycle could start in September. He says the market now awaits the RBI MPC outcome next week, with the central bank expected to keep interest rates steady for the 9th straight meeting. He says crude oil prices extended gains as geopolitical tensions raise the threat of a wider conflict in West Asia and concerns over its impact on oil. He says the coming sessions could see the 10-year benchmark bond yield trade in a range of 6.85 to 7%.
Well, we've got a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. For the time being, we run it through the list. We're looking at Tata Motors, ITC, Kalyan Jewellers, Zomato, and Engine. We'll be tracking all those stocks in terms of positive news flow. On the flip side, you have Sun Pharma, Hero MotoCorp, you have Eicher Motors, Maruti, as well as NetWeb Technologies that will be reacting to negative news flow.
Okay, well, so that's essentially the list of stocks coming up in just a bit. Mark Matthews is with Bank Julius Baer and Companies with us. Mark, great to have you with us here on the program. Thanks very much. So is the market starting to doubt the soft landing? I mean, it's just sort of one or two data points on the labor market side, but really soft. What did you make of it and the market reaction then?
I agree with what you just said, Prashant. It's just one or two data points. It's hardly enough to tell us that a recession is coming. Now, I would say that there have been so many recessions forecast by economists that didn't end up happening, and many recessions that they did not forecast that did end up happening. So it is hard to predict recessions. It's hard to predict their timing. And we know that in a capitalist economy, they do happen. But I think we're many, many months away from a recession, in fact, a few years. And the data point that was most seized on, the initial jobless claims, it's a weekly number. It's a very noisy and volatile number. I think really when the market is going down, people just look for excuses and they latch on to anything that looks bad.
Mark, hi, good morning and good to see you as always. Your thoughts on the Indian markets, because it's been, such a great opportunity for investors the last many weeks and months. If there is a fall in global markets and it takes India with it, would this continue to be a buy on dips market?
Well, yes, but I mean, a dip, whatever you qualify a dip by, I would say at least 10%. So A pullback is, let's say, between, let's say 5%, and then a correction would be 10%, and a bear market is anything more than 20. I would be a buyer in that territory between 10 and 20% below where we are now. Because if you think back to 2022, when the S&P fell almost 20%, the Nifty was basically flat, and there are not many foreigners invested in India. So the dynamics that took India down so much, for example, in 2008, the global financial crisis, were really where foreigners had heavily overweighted India going into the global financial crisis. They're not very present in the Indian market today. I don't think, therefore, that they should be big net sellers of the market. There's just not enough of them to make a difference. And locals should, I think, be still quite constructive on the market, given the earnings growth will be in the low double digits this year and probably for the next 2 years after as well.
Hi, Mark. Good morning. What about the toss-up between India and China? China showed signs that it was coming back. But again, those data points are looking extremely weak. And, whatever the government is doing, whatever the banks as well as doing out there, the economic data is still not showing up. The toss-up between the two, would you still lean towards India versus China, irrespective of those valuations?
Well, they're polar opposites in the sense that India is a growth market, China is a value market. China used to be a growth market 10 years ago. There were all kinds of exciting up-and-coming companies, technology-related, growing their revenues and their profits in the 20 to 30% per year kind of range. That's all gone since common prosperity was enacted a few years ago. And so what China is today, in my mind, it's an undervalued market. It's being priced as if it has no growth. In fact, the earnings growth for China this year will be in the high single digits, somewhere like 7 or 8, 9%. But it's the old stalwarts that are, kind of driving the market. And what I mean by that is state-owned enterprises, just big, old-fashioned companies, not exciting new growth companies, which I think exist in India.
Got that, Mark. By the way, I don't know if you have a view, but I was just reading that predicted the betting a betting website is now predicting Democrats to win in November. It was looking, just a couple of weeks back, it was looking like Donald Trump was cruising to a comfortable win. And that's how fast things can change, right? So that's politics, but I think the lesson applies in markets as well. Any thoughts?
Yes, I think Predictit is the most reliable of the betting websites because they only accept small bets. With the other ones that are for profit, you can go in with $100,000 and really skew the odds on some of these events. Predictit, there's tens of thousands of people making small bets, so it's a better barometer, I think, of what sentiment is. The thing is that it's a barometer of the popular vote, and as you know, in America, who gets in the White House depends on the electoral vote. And the person who's got the best record for forecasting that is a fellow named Nate Silver. And his model, which is very complicated, but he got everything right except 2016. And even in 2016, he gave Trump the highest odds out of any pollster. But he's still saying that Trump is far ahead in the electoral vote. I wouldn't say it's impossible that the Democrats could be in the White House, but I think if they are, the Republicans will retain control of the House of Representatives, which is the legislature. What it will mean is that on top of not extending the Trump tax cuts, a Harris administration would not be able to spend much because the Republicans always become deficit hawks whenever there's a Democrat in the White House. So that would be material. I think it would probably actually be bullish for treasuries. But for now, our base case is still that the Republicans will win the electoral vote, so they'll get in the White House and they will retain the House of Representatives and they might even get the Senate.
All right, Mark, we'll let you go on that note. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. Let's slip into a quick break, but we have a market to trade and we have plenty of stocks to talk about, so don't go anywhere. When we come back, our list of top 10 stocks is lined up. Stay tuned.
Welcome back. As promised, our research team is standing by with CNBC TV18's top 10 stocks for the day. Sonia, you go first. Tell us about Tata Motors.
Well, it was a good quarter for them, better than what the street was estimating. So I'm going with green on the stock. The JLR guidance was retained for the quarter, but the only issue is that the management commentary was a bit cautious. They did say that there are demand headwinds that they see in China and Europe for the JLR market, and the customer acquisition cost has become high. But leaving that aside, the numbers were quite good actually. The revenue went up 6% year on year on a consolidated basis. EBITDA was up 19%. The margins went up 170 basis points year on year at 14.6% overall, and the profits went up 74%. Now, a lot of brokerages have raised their target prices on Tata Motors post the numbers. Jefferies has raised it to 1,330 versus 1,250 earlier. Nomura has revised it higher to 1,303. Everyone speaks about how Tata Motors is seeing, better profitability in the JLR business. Yes, there are some headwinds which the management has been cautious about, but otherwise they are on track to meet their full year guidance as well. So I'm going with green on this stock.
Okay, all right. Thanks a lot for that, Sonia. Well, the other big name will be ITC. Manglam joins us to help us with a quick analysis. Morning, Manglam.
Good morning. So it was good internals that came in from ITC. You know, if you look at the revenue that came in at around 17,000 crores, the street was working with a number of 16,700 crores. EBITDA, one would say that it's close to 6,300 crores versus expectations of 6,400 crores. And as a result of which, there was a mild miss on both profits as well as margins as per our expectations. But that was led by the non-core segments of the company. If you look at the cigarette business, volumes at 2%, absolutely in line with expectations. FMCG, in light of the consumer environment, pretty resilient, 6% growth versus 7 to 8%. Hotels and agri revenue actually beat street expectations, but paper business was weak, and that actually led to the EBITDA miss as well. Paper EBIT was down 45%. The margins came in at 13% versus 22%, and as a result of which, the overall EBIT was lower. Agri business as well, margins were a little lower as compared to year on year. What really stood out was the cigarette business. Out there, the operational performance grew by about 6.5% versus expected 4 to 5% growth. And at the same time, the premium end of the business is doing a lot better, telling you that margins out there are resilient as well. The stock has rallied, but still at 28 times. Maybe we see some green today.
All right, Mangala, thank you very much for that. Let's revisit Sun Pharma. Numbers came during the last hour of trading yesterday, but Ekta is here with more detail. Ekta, morning.
Morning. Well, a couple of conference call takeaways. So the one negative which came out from the conference call, and it was in the press release, but maybe the street will probably take more cognizance of it, is that there is a preliminary injunction which is filed in a US court to prevent the launch of this particular drug that they've received approval for, Lexelvi, for alopecia. So it's supposed to be a big drug for Sun Pharma, but the company did indicate on the call that they cannot talk about when the timeline for launch would be now. The company, however, intends to rigorously oppose that motion. They are expecting a step up in R&D costs in subsequent quarters. The guidance has been 8 to 10% of sales. Taro is now a wholly owned entity by Sun Pharma. Both the teams are working on integrating Taro and Sun Pharma. They will request the US FDA for a re-audit of Halol, the Halol facility, which has an import alert since 2022, and only when they are 100% sure. They are expecting it shortly, but just because of that preliminary injunction, I expect the stock to probably be a little subdued on account of that.
Okay, thanks a lot for that. I'm watching out for 3 auto stocks this morning. Maruti, I'm going with red over there because the sales in July were below street estimates, and in fact they were down year on year as well. Total sales down 3.5% year on year, coming in at 1.75 lakh units. We do know that the domestic passenger vehicle market is going through a slowdown currently, and that's reflected in the numbers, so I'm going with red over there. Even in the two-wheeler space, actually, both Royal Enfield and Hero MotoCorp saw a degrowth in their sales, so I'm going with red on both those names. Royal Enfield sales down 8%, lower than Nomura's estimates. Hero MotoCorp sales down 5.5%, going with red on these 2 stocks. So all 3 stocks, in fact, in the red this morning.
Okay, all right, Sonia. So we got those auto names. But coming back to you, Mangalam, Kalyan Jewellers, they give us the cheat sheet, but the numbers as well look good.
Yes, the numbers, reported numbers are in line with that cheat sheet, and more importantly, the internals are good as well. The company had already given us the update. Margins are lower as expected, and that's largely because of the higher share of revenue coming in from the franchise-owned stores. 26.5% revenue growth, 16.5% EBITDA growth, and 24% net profit growth. Not a bad one, given there were no festive seasons, etc., or big days in the first quarter. The same-store sales growth at 10% stands out. South business showed an 18% revenue growth, whereas the non-South business, where the company is focusing, grew 42%. Even the studded share actually grew 35%, and that's a positive too. Way forward, the company is guided for mid to high single-digit same-store sales growth, increasing the share of revenue from non-South geography, and also looking at sale of some immovable non-core assets in FY25. Were that to happen, that would be an additional kicker, going with green.
Mangalam, thank you very much for that. But let's also talk about Zomato, because numbers came yesterday, again during market hours, but I reckon a lot of chatter continued through the course of the evening on social media, etc. Those Blinkit numbers, and I think it continues this morning into this morning as well. Take it away.
A lot of chatter, and more importantly, the presentation actually came post the market, and there was some interesting insight. The food delivery grew about 26.5% on the GOV basis. Jefferies was expecting a 20% growth, so that was a positive. And the company said that it's compounded at 30% over the last 5 years. There's no reason to believe it won't continue. That's a positive, and they're on track to getting 4 to 5% adjusted EBITDA margins out there. Blinkit, that was the standout performer. GOV up 130%. The street was working with a number of 120%. And the company has revised their 1,000 stores guidance by 2025 to 2,000 stores by 2026 with profitability. So that's the big positive out there. And they've said that the GOV per store has increased to 10 lakh rupees per day as against 6 lakh per day last year. And for the top 50 stores, the gross ordering value per day on Blinkit is 18 lakhs. So that's a positive. And most importantly, they've also seen increasing use case in going out when it comes to movies, sports ticketing, live performances and shopping, for which they are going to announce the District by Zomato app. Remember, earlier the company had confirmed that they are in talks with Paytm to buy their ticketing business. Could this be one of those? Will be very crucial to monitor. See green on Zomato today too.
Okay, see green on Zomato. Lots of brokerages have raised their target prices on the stock. Motilal Oswal has a target price of 300. Which is, I think, one of the most aggressive on the street. But Ekta is back with us to talk about Indegene. Ekta, over to you.
Well, yes, recent listing coming out with its Q1 numbers, revenue up around 11.4% year-on-year, margins 19% versus 16%, so improvement there. Profit up 28%. The company says that now they are a zero-debt company. They anticipate that the financial leverage will be driving a stronger profit going forward. Anticipate that the EBITDA margin could have a similar trajectory as FY24. They overall expect a stronger second half versus the first half.
Okay, thanks for that, Ekta. Well, let's go back to Vivek. He's here to tell us about NetWeb Technologies is looking to raise some money. Morning, Vivek.
Well, good morning. That's right. A block deal is expected in NetWeb where the promoters are looking to pair stake. Remember, they hold over 75% stake in the company. They're looking to pair close to 3.4% equity, and this is likely to happen via block deal. So 4 promoter entities, all of them will be pairing part stake. The floor price for this particular deal is at 2,180 rupees a share, which means that the total offer size is over 440 crore. Expect this particular deal to put some pressure on the stock on the back of the discount given.
Okay, thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow: Tata Motors, ITC, Kalyan Jewellers, Zomato and Indegene. While stocks with negative news flow: Sun Pharma, Hero, Eicher Motors, Maruti and NetWeb Technologies. But let's also get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what are you looking at this morning?
Well, I'm looking at the crude oil prices, Sonia, because we are looking for a 4th weekly decline on this one. This is the longest losing streak since December 2023. And yes, there are weak manufacturing data that we have seen from US, from European Union, from Asia as well. When you look at the China fuel oil import itself is down by 11% in the first half of 2024. So various factors which are weighing on. Of course, the concerns of broader conflict in Middle East is something that keeps the prices supported as well. But a sector that clearly is rising today is the precious metal prices. You have gold trading very close to its all-time highs. Silver prices have gained up by more than a percentage point in the Asian markets right now. Most of the banks and brokerages still reiterating that we are looking at all-time highs anticipated in this year and the next as well. And with the kind of confirmation or the Fed futures probability showing 100% possibility of a 25 basis points, even a 29% minor there is something that clearly has been supportive. For today, it's going to be the U.S. non-farm payroll data today in the evening. All eyes onto that data.
Okay, all right, Manisha, thank you very much for that. So that's the big one that we'll watch out for. We'll take a quick commercial break here. Siddharth Khemka of Motilal Oswal Financial Services joins in on the other side, and we discuss individual stocks with them. Stay tuned.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBCTV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Welcome back. Hope you're having a good morning. Well, the markets are indicating we're likely to start off in the red, but plenty of stocks to discuss and help us out with some fundamental analysis. Sid Kemka, Head Retail Research at Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Good morning and good to see you. Well, let's talk about big boy ITC. That came out with its set of numbers. Some part of the street believes it's a little bit lower after the run-up of 15-20% odd. Though valuations are quite comforting. Your view on the stock?
Good morning, Nigel. Glad to be on the show early morning. So if you look at ITC, yes, results are mostly in line to marginally below expectations. The stock has definitely seen a run-up. But if you look at the overall picture, last few quarters, ITC was kind of outperforming the other FMCG peers. And now the others are catching up in terms of growth. And for ITC, the core business growth is kind of maturing. So I think from here, the view definitely remains positive. There will be definitely more upside to the stock, and we have a positive view and a buy rating. But I think some of the other consumption stocks will now pick up and start outperforming ITC, with the rural consumption picking up, with the core your staples doing much better now. And with monsoon being good this year, I think some of the other companies, for example, the levers of the world, the Godrej consumers, these kind of companies would start outperforming ITC from here on.
What about Zomato? I was just going through one of the notes at Motilal Oswal itself, and there's a 300 rupee target price that you guys have on Zomato. So is there still a big upside? I mean, you don't believe that a lot of the good news is in the price already?
Yes, Sonia. So I think Zomato continues to surprise, and what does is the Blinkit business, which kind of keeps showing the growth given the disruptive nature and the evolving business in the quick commerce business. So the gross order value for Blinkit grew 100%, and this is the most important factor driving the DCF-based target price for Zomato. Overall, the food delivery business reported strong numbers. Profitability has now kind of matured, and we expect the margins to continue at these levels. They have so the food delivery business would continue to give a contribution margin of about 7.5%. So we expect Zomato to report a PAT margin of 4% for current year and about 8.7% for FY26. And given that Blinkit offers a once in a generation kind of opportunity to participate in a disruptive industry such as retail, grocery and e-commerce, we believe there is much more steam and room for upside. Hence, we value it at a target of 300.
Got it. Sid, hi, morning. Pharma, right? I mean, there is Sun, which reported, Ekta was outlining the numbers. It's one of the better performing sectors lately, right? So what is your call? So Sun has reported, I think Divi's will report, Lupin, I think over the weekend. What do you like from that space?
Yeah, Prashant, so I think, yes, pharma has kind of started showing the growth, A, on the base effect, B, on the improving growth trends in some of the key markets, and also kind of stabilization in the cost prices leading to improvement in margins. Domestic market is the way, so domestic formulation is the key growth driver. And for example, Sun delivered better than expected growth in Q1, led by improved segmental mix and lower raw material costs. We expect Sun Pharma to continue to do well. It is one of our preferred picks and top picks in the pharma space, given the rising contribution from the specialty products, progress on some of the key developments, R&D products. And in generics business now, as I said, the US, European markets kind of showing improvement and growth. So we have a buy rating and a target price of almost 2019-80 is what we value at. And we prefer Sun Pharma in the pharma space.
Okay, well, there's lots happening in the auto sector. There is, of course, Tata Motors numbers that we have to discuss. There are auto sales that have come out for the month of July, as well as there is the Ola IPO opening today. So much to talk about. Abhishek Gaushinde is joining in. He's the Deputy Vice President Research at Sharekhan by BNP Paribas. Abhishek, thanks a lot for joining in. First on Tata Motors, what did you make of the numbers? The management commentary was a bit cautious, but overall numbers looked good. What's your call on the stock now?
See, broadly, yes, rightly, the numbers were almost in line with estimates. What I can say that at the EBITDA front, although margin was slightly above estimates. Going forward, what is happening that management is holding up its guidance for the JLR for FY25, and its commentary for CV segment has been improving compared to what was in the previous quarter. In the PV segment, we know that it is the inventory issue, but what company is backing up on is its sustainability on its EBITDA, its market share, and aiming for an improvement in its operating performance. In coming month, it is launching a product curve, which company is expecting to further boost up its position in the market. See, overall, what is really happening? This Q2 and Q3 may see some kind of a headwinds in the volume side in a JLR front, mainly due to the issue with the vendors. But management is saying that it will mitigate it by generating the alternative sources. What is the call on the Tata Motor is that overall the structure of the company has been changing. Companies is delivering now the sustainable performance, given that this was the consecutive 6th quarter when the JLR has reported more than 1,000 million GBP kind of EBITDA, which was earlier a phenomena which we see in the quarter 4 only. But now it has been sustaining the performance, and this sustainability is building up a kind of a predictability in this business model, which the street is liking. So considering that structural thought process, we have been positive on Tata Motors, although we can see some kind of a hiccups in JLR's volumes in a short term, which we believe that company would manage over the period.
Okay, so that's on Tata Motors. I wanted your thoughts on the Ola IPO as well. It opens today. It's a big one, although of course, it has a huge market share, but it's also sitting on big losses. What is your recommendation to investors?
See, in generally, due to the compliance, we do not recommend on the IPOs. But what I can add on here is that it is a different kind of a company compared to that what we have been seeing in the listed space currently. It's a startup. It's obviously it has been making up losses, which may come down if the volumes would surpass. But what uniquely this company is offering, it's a bouquet of an vertically integrated business model, which has its own benefits and negative issues. It's an compared to the other two-wheeler OEMs, it has been making most of its raw material in-house. It has its own gigafactory project, and it has its own distribution network. So say, for example, the currently listed legacy players are just manufacturing the product and selling to the dealers, and then the dealer is selling to the customers. So they are not managing the working capital kind of a thing. But here the company has to carry on the inventory on its book because it has its own distribution network. Side by side, when you are manufacturing all the components together in-house, then definitely the recall and the warranty issues would also be with you. So you have to do capex for that, and side by side, if everything will go, then you will only enjoy all the benefits. So the ecosystem part which the other players have been developing, that is not the case here. I just give an example that few years back, one of the players went to the West Bengal with its own ancillaries ecosystem, but that has not been worked well. So the pressure or the losses was being shared by all the players. But here, if something would happen, then this particular company has to bear all the fruit. So this kind of risk is also assisted with the company. But side by side, it's giving an opportunity to play a early stage, play a EV cycle at an early stage.
Okay, interesting. So it's giving you an opportunity to play the EV cycle at an early stage. But the important point, as you just made, right, is that in order for its losses to go down, the EV market needs to expand exponentially, which is looking tough at the moment, given that it's already sitting at over 40% market share. And we're seeing a little bit of a slowdown in the EV market in the two-wheeler space currently. So got that. Finally, on the auto sales, we noticed that two-wheelers are under pressure, whether it's Hero MotoCorp, whether it's Royal Enfield. There's degrowth this time around. Would you be cautious here, or would you look for an opportunity to buy?
In the case of Hero MotoCorp, what we understand that it was an issue with the logistics issue and some capacity constraints. So even if you see that the YTD numbers, it's still reporting a high single-digit kind of a growth, given that the first 3 months were very good. But what is important to see here is that among the overall auto pack, two-wheeler volumes are still at a high single-digit growth rate if you are seeing the YTD numbers. And as the festival season would kick in, we believe that the current inventory would come into the actual sales, and that would help the players to build up inventory for the latter part of the festive season. So far, we are not so much worried on this Hero MotoCorp per se. In the case of iShares, that it has been somehow lagging the volumes for last 6 quarters or 5 or 6 quarters. If you see that its RE volumes is stagnating around between 225,000 to 30,000, and in this month it's also somehow lagging. So that we can say that's an issue with that particular category only. And as the festive season would kick in, we are waiting that how this particular iconic premium category would take into the shape going forward, that from August onwards that Gorilla 450 will be available. So we are hoping that some makeup would be happen after this Gorilla would be available in the market in the case of
Okay, so I didn't get your view on it. At this, it's almost now at 5,000 rupees, Aisha. Is the risk reward still favorable?
See what is happening that post this rise in the competition, it has seen some kind of correction in the valuation. So from valuation per se, it's not so premium at compared to that was in the earlier cycle. So valuation part is saying the critical thing is that the volume performance that would drive the earnings. So say for example, for last 3, 4, 5 months, we are seeing this Hero MotoCorp and Bajaj Auto at 19, 20 and 25, 26 kind of multiples. But despite that, stocks are performing because they are outperforming in terms of the earnings. So earning outperformance is the critical thing which we are looking in the Royal Enfield. That's why our preference is currently more towards the mass market players like Hero MotoCorp and the Bajaj Auto.
Okay, all right. We will leave it at that. Thanks a lot for joining in and giving us your take on the auto sector. Siddharth Khemka is still with us. Siddharth, I wanted one word from your end on the Ola Electric IPO because the street is a bit divided on this one. Which side of the fence are you on?
So again, a very difficult question. While we have no official view on Ola, I think the current business and losses and the company's plan to get into even lower cost models could keep the profitability little far away. Having said that, it's a great opportunity to enter into the EV space through a direct OEM, which was so far not available, pure play EV play. So I would remain on the sidelines and would wait for some quarterly results and some business trends to see, and then only take a firm view on Ola.
Okay, all right. Siddharth, I wanted your view on metals because today, in fact, that set of stocks could pull back a little bit, but we have been seeing on this set as well, since the balance sheets are in far better shape, and a lot of focus on the cost side, all those dips have got bought into. What's your view and what is the preference on the metals pack?
So, Nigel, I think if you see overall, the upcoming rate cut, whenever that happens, would be positive for the overall metal companies. We have seen some improvement in global markets and demand environment from the US markets, and especially for metals, the Chinese markets have kind of seen some improvement. And on back of that, we have seen, despite the results not being that strong, some of the market interest for metals has improved. So what we believe is that overall metals after a high base and then the numbers would now start recovering. Overall, the global outlook seems to be far improving than compared to the 2 quarters back. And within that, what we are expecting is some of the so the non-ferrous side is something that we like. So Hindalco is our preferred pick, and then on the broader metal space, to play the broader metal space, we like the mining company called Coal India. The company came out with very strong results and that is a good way to play the overall power sector as well as the metal space, because again, as you see globally, a lot of volatility is there, and that could have a direct impact on metal stocks. So the preferred way to play this space is Hindalco, which is on the aluminum side, where the value-added contribution is going up, and Coal India from the mining space.
Okay, all right. Sid, we'll take a quick commercial break here. I have to do that. We're running to market open, about 11 minutes away, the pre-open session, that is. So more stocks, more ideas. Our technical experts also join us on the other side. Stay tuned.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
Welcome back to Bazaar Morning Call. Well, this morning we have Mitesh Thakkar and Shrikant Chauhan of Kotak Securities joining in to help us with some technical calls for the day. Gentlemen, morning to both of you. Mitesh, let me start with you. Given that there is a sell-off that is likely because of the global cues, would you suggest buying the dip, or would you just wait and watch today? What's the best approach?
Yeah. Good morning. So I think I've been highlighting that the Bank Nifty weakness is preventing Nifty's sustained move about 25,000, and today with the gap down, I think that Nifty momentum on the intraday charts might also take a backseat. I think we might see some kind of pullback to about levels of 24,800 to about 24,785 zones, and in case post the gap down we see that level holding out, then I think a long trade would be warranted. Otherwise, I'll be in wait and watch.
Okay.
Gentlemen, morning. Shrikant, what about you? What would your way to approach the index be if you get that big gap down?
Good morning, Prashant. Good morning, everyone. I think, the broader structure of the market, and if we see the entire setup of the market, then the overall trend of the market is still bullish. And the strategy should be to buy on dips to follow, because we saw a rally of almost 1,000 points from the day of budget outcome. It was around 24,078 on the day of budget day. And from there, all the way, we saw the levels of 25,078 on Thursday. So yes, we could see some correction, but I think close to 24,700, 750, the market is having excellent support. If we see the market is dropping to those levels, then there again, we should look for taking some select bets in this market. I'm of the view that it is going to consolidate furthermore. The broader support is at 24,500 levels. But the way today it is correcting from the highs, I think 24,700 should act as major support.
Got that. Mitesh, so what would you trade in terms of individual stocks? Would it skew on the downside, or you'd still look for ideas to buy?
I have a mixed set of buys and calls today, and a couple of stocks are clearly now showing signs of a pullback and a breakdown with yesterday's price movement. And cement was one of the stocks, sector which suggested some profit booking, barring an Ultratech Cement. So I have a sell on ACC right now. Look for targets of 24.30. Stop loss can be placed at about 25.11, and a sell on BHEL with a stop at 315 for targets of 294. On the buying side is BSE. I think that reversed very nicely. So buy here with a stop at 2600 for targets of 27.25. And one more call is Shriram Finance, which is a buy with a stop below 2945 for targets of 3100.
Okay, Shrikant, what about you? What would your stock ideas be for the day?
Yeah, Sonia. I would like to go with those stocks which are into very strong breakout patterns like Tata Power, which is currently around some 460, 65 sort of levels. And it has absorbed selling pressure somewhere close to 450, 55. So if we see the stock is dropping to 455, 456 levels, then there we should look for taking long bets with a target of 490, 500. It's a very long-term breakout sort of formation for the stock. So it's a buy with a stop loss close to 445. And the other stock which we like is Reliance Industries. And I am of the view that whenever there is an uncertainty in the market, we see some buying interest in large cap companies like Reliance Industries or HDFC Bank. So I think there we should look for taking some positions. I think Reliance Industry somewhere close to 3020, 30 looks decent buy with a risk reward ratio because it is at its important support levels. So 2970 should be the final stop loss for creating long positions on Reliance Industries. I am expecting stock to move towards 3075 or 3100 in the near term.
All right, so about 100 rupees from here. Gentlemen, thank you very much for now. 4 minutes to pre-open. Watch the pre-open, and we'll chat again at about 9 or 10 with a couple of more ideas. The implied open is still indicating a 200-point lower start. We'll take a break. We are back with more on the other side. We'll have the pre-open rates, of course. We'll also be joined by the management of Max Healthcare, first corporate on the show, to talk about their first quarter earnings. Stay tuned.
"25 years of excellence and unparalleled growth."
CNBC TV18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and cnbctv18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Welcome back. The next corporate on our radar is Max Healthcare. Now, if you look at the numbers, right, it was a pretty good set of numbers actually. The revenue growth has been almost 19%. The EBITDA went up 14.5%. This entire space, the hospital space, has been doing quite well over the last many quarters. The profits, though, were largely flat, but the margins have been stable around the 25-26% mark. I think the revenue growth for the company also has been led by the oncology and the general surgery segment, which has been doing very well for Max Healthcare. So that's, one segment. Their average revenue per bed has also gone up, so that's looking pretty good. Occupancies have been high at 77% for the quarter. Let's in fact find out more about what's happening. Abhay Soi, the chairman and MD at Max Healthcare, joins us now to discuss this. Abhay, hi, good morning. Always good speaking to you. I wanted to start by asking you about the growth itself. I mean, revenue growth was led largely by, the growth in the ARPOB was led largely by the oncology and the general surgery segment. What kind of ARPOB are you expecting in Q2 and Q3? And overall, in terms of occupancies as well, can you do better than the 77% that you saw for the quarter? Abhay, I can't hear you actually. I think you're on mute.
Sorry, my bad.
Go ahead.
So the 77% occupancy is for the existing hospitals. The newer hospitals, of course, both Lucknow and Nagpur are at about 60%. So there is headroom, of course, over there for occupancy growth. But with respect to the existing hospitals, we're looking forward to our brownfield expansions coming on stream over the next 8 to 10 months. And, till then, there's only going to be incremental sort of growth as far as occupancy is concerned, because we're pretty much up to the gills with capacity.
Good morning and good to see you, Vin. Revenues growth has been strong, 18%, and I understand your ARPOB is up by close to around 7%. Could you help us out with what was your surgical contribution to this entire mix that's helped the ARPOB go up?
So we do typically 60-65% is surgical contribution, but within that, what we've seen is a sort of churn towards higher end clinical programs, preference towards robotics, preference towards more sort of complex procedures, etc. And that has kind of tilted the balance. And we've had about a 6 to 7% increase in the sort of high end surgeries that we're doing, and that is effectively what has led to higher ARPOB.
What's the outlook on the ARPOB from here on?
Well, I'm going to avoid giving guidance on ARPOBs as I sort of usually do. But I don't see any reason. This is our 15th consecutive quarter of highest ever performance and, highest ever ARPOB. I don't see any sort of reason for, the past growth to abate. And I believe that should continue.
Hi, morning. The Dwarka hospital, is it up? I think it was supposed to come up in June, right?
That's correct. So we actually commissioned it, on the 26th of June, 27th of June. So it's up and running now. It's on full steam. We're very excited about this new facility. It's a 300-bed facility and state-of-the-art, which is started in Dwarka. So, that is something that is should perhaps break even towards the end of the year. And, good tidings thereafter, hopefully.
The Lucknow and Nagpur ones, as you told us, that'll, they in terms of coming up on full steam, it'll only be towards the end of this year, Abhay?
No, so, we've had a very exciting first 3 months with both Lucknow and Nagpur. Effectively, we stepped into when we acquired these hospitals was last week of March. So really, these first 3 months itself, basis previous year's performance, we've had a 56% increase in EBITDA. It's one thing to have it once you're in operation 8 or 9 months down the line, but it's another thing to sort of do it in the first 3 months. So, that's been remarkable as far as the teams are concerned. And all of those sort of, and this is essentially, of course, due to all the low-hanging fruit that we were able to identify during our diligence stage. But as we put integration synergies and so on, we're going to see a major fillip over here over the next, few quarters to come. As we are now adding clinical teams, we're adding doctors over there, we are, upgrading the infrastructure and so on and so forth, a lot of which we should be getting done towards the end of the year. Other synergies that we are putting in place. So, having said that, a 56% year-on-year increase in EBITDA in both these hospitals, I think is a very, very good start.
Just saying on that sort of line of thought in terms of capacity, and I think you've been the most acquisitive in the hospital space over the last many years. Is there more coming? I mean, there are at least, I think we all know there are at least 2 deals in the market, which we know of. You, of course, know many more. Should we expect something more, Abhay?
We certainly hope so. We continue to have net cash positive position as far as our balance sheet is concerned. So, we don't have any net debt. We, in fact, and every sort of quarter, we are contributing to the kitty as well. I look forward to having at least 2 to 2.5 times debt to EBITDA, which gives us about 5,000 to 6,000 crore kitty at the very least as far as acquisitions are concerned. And I certainly hope that, we'll be able to put it to use in the near future.
Okay, what about the capex? What is the total bed addition plan and how are you planning to fund it? I mean, you can take on some amount of debt, as you just mentioned, right? You're net cash positive at the moment. But over the next couple of years, what would the capex look like and how would you be funding it?
So I think over the next 3 to 4 years, we are looking at capex of close to 5,500 crores. But given our free cash flow generation every year, even at present, we will be able to more than sort of absorb it through internal accruals itself without raising any external financing in the form of debt or anything else for our capacity addition. This should take our new capacity northwards of, I think, 8,000 beds over the next 3.5 years. And we still have room for acquisitions with our balance sheet, I presume.
Okay, all right. Abhay, I wanted to ask you about your international revenue that's flattish on a quarter-to-quarter basis. As a percentage of sales, what is it likely to contribute going ahead?
Well, it's been hovering around 9 to 10% of our sales. This particular quarter, there were some sort of setbacks in some of the markets in Africa because visas were suspended. I believe they're back now. This has been typically in the past been growing at 20-odd%. We believe that should sort of continue and, exceedingly have a larger share of business that we have. So, we are at 10%, 9 to 10% of our total revenues at present.
Okay, and very small part of your business is MaxLab, but now it's doing close to around 40 crores on a quarterly basis and it's scaled up nicely and margins as well have improved. So for the year, should this do around 200 crores odd? And how do you see scaling up of this smaller part of your business?
So, MaxLab has been doing very well. It's been, the growth CAGR has been about 23-24% now for, I think, many years now. It started with a very small base and yes, it should certainly cross the 200 level. At this, again, we don't see any reason for their growth to abate. And, along the line, if we get an opportunity for doing any sort of plug-in acquisitions, we don't want to spend too much money. We don't want to use cash to be able to fund any acquisitions in this. But, if we can sort of do any bolt-on transactions into this company, I think, into this vertical, I think we'd be sort of happy to look at those. And once it gathers steam, we always sort of guided that once it, grows beyond that particular critical mass, we'd be happy to sort of put it on its own rails and have a separate company out of it.
Okay, Abhay, we leave it at that. Thanks a lot for joining in and speaking to CNBC TV18. Well, let's just get the pre-opening rates in because looks like it's going to be a really tough day. The Nifty is down 220 odd points and lots of stocks in focus. Tata Motors is down 2.5%, post its numbers. ITC is down about 2%. Eicher Motors, you have Hero MotoCorp that in any case have reported weak numbers this time, so there's pressure there. Interesting to see what something like a Zomato is doing right now, post its numbers and the presentation that was uploaded. So keep an eye out on Zomato, 4.5% higher in a falling market. Well, Mitesh is back with us. Mitesh, what's the 9-10 call?
I'll go with a sell on BHL for targets of 294.
Okay, a sell on BHEL, got that. If you're wondering about ITC and Zomato and how, what the news flow is on that, Mangalam is here to give us more. Mangalam, over to you.
Well, both of them reported good numbers. Zomato actually, was much ahead of street expectations in terms of performance coming in from Blinkit, and ITC too was rather resilient. So this morning we've had a lot of brokerage upgrades coming in as well. CLSA, for instance, has raised Zomato's earnings by 6 to 36% over the next couple of years between FY25 and FY27, and as a result of which they've raised their target price to 350. Remember, Zomato's already seen a big rally, and CLSA believes that there is room all the way up to 350 over the next 12 months or so. Motilal Oswal too has a target price of close to around 300 rupees, and they've said that Blinkit actually defies our attempts to value the stock fairly, because every time the company reports their numbers, Blinkit has surprised positively. The company has gone ahead and increased their guidance out there as well, and as a result of which brokerages go ahead and increase their valuation parameters there. Nomura too have raised their target price to 280. Citi and Jefferies are both pretty positive on their dining out or going out business, where Citi has a target price of 280. They believe that the going out business has swung to operating profitability, and Jefferies says that this is an area of interest with the new app coming soon, so all eyes will definitely be on the District app which Zomato will launch, and more importantly we'll watch out for whether they go ahead and do buy Paytm's internet ticketing business as well. For ITC, it was a resilient performance, and as a result of which we've had a couple of brokerage upgrades coming in there too. Macquarie says that the target price at 560 is an outperform for them. Flattish taxes in the cigarette business actually gives them room to drive innovation-led growth in cigarettes, and that's exactly what happened in the first quarter. And FMCG EBIT will benefit from personal care pickup and rural recovery. CLSA too has raised their target price to 524, and we have Morgan Stanley, which says that hotels and agri actually saw revenue beats, whereas cigarettes and FMCG were largely in line. What happens to the paper business is something that everyone will monitor. They too are positive on the stock.
Okay, thanks a lot for that. We're also looking at Tata Motors. It was a good quarter, better than what the street was estimating. The GLR guidance was retained, but I think the stock is under pressure because the management commentary was on the weaker side. They did talk about how there are demand headwinds, especially for JLR in China and in Europe. And they talk about how customer acquisition cost has also gone up for them quite a bit. So this is perhaps a reason why, given weak commentary, the stock is coming in for some profit taking. But having said that, the numbers were not bad. Consolidated revenue growth of 6%, EBITDA growth of 20%, margins up 170 basis points, and the profits up 74%. Jefferies has retained a buy. They've raised their target price to 1330 on the stock, and Nomura has revised their target price higher to 1303 as well. So that is on Tata Motors. But Mitesh Thakkar is back with us. Mitesh, on Tata Motors, what's your view? I mean, it's given a very strong run. Would you use this dip as a buying opportunity?
I think, given the fact that in the short term, I would link my buying to the index movement, I might want to wait it out, but otherwise the stock is pretty good. In fact, around 1090, 1100, in case you get in that range, I think, that'll be a fresh entry point. Keep a stop below 1075 here. We might see stock head towards 1200 plus levels very soon.
Okay, all right. Well, let's also look at escorts this morning because, the numbers came out and brokerages have written on the stock as well. JP Morgan has an underweight with a target price of 2390, which is a big downside to the current market price. They say that demand is improving. The margin momentum is expected to continue, but the management continues to maintain a guidance of a mid-single-digit industry growth. So it's only a mid-single-digit industry growth that the company continues to expect. CLSA has an underperform. They have a target price of 2439. They say Q1 was slightly ahead of estimates, led by a better product mix and some cost reduction measures. So that is on escorts. Mitesh, a quick word on escorts this morning.
See, escorts again, as a stock has done extremely well, and then now last couple of weeks it's gone into sideways activity. My sense is that the range is about 4260 to about 3900 for me. Once we see a breakout beyond 4260, a next wave of up move could start.
Okay, all right. Next wave of up move could start. By the way, any thoughts, Mitesh, on some of the big movers from yesterday? And we had quite a few in the auto space, especially on the downside. Mahindra, Hero. How are these looking?
See, I think two things. One, Hero Motors. If you look at the history of the last 3-4 weeks, Prashant, I think it's not had a breakdown below 50 to 90, 5300 zones. I think once that closing happens, then I think you might see a stronger correction over there. M&M appears to have triggered some kind of a pullback move, so it's slightly negative in the short term. I think 2700 is the first pivot area. we might touch those levels. And then in case we start breaking below that, then we look at further declines.
Okay. All right, we've got the market open coming up in just a bit. Mitesh, thank you very much for that. First rates, and it'll be down one as the pre-open has left us with 200 points lower. That's under 1% fall. The Sensex similarly about 0.9% down. That's about a 700-point cut. And I think we'll have the mid-cap and small-cap indices. By the way, last 2 days now, small caps and mid-caps have underperformed large caps. Actually, the small cap index sold off towards in the last hour yesterday. Actually, day before yesterday, it sold off in the last hour. And yesterday, of course, it ended down 1%. Both the broader market was in trouble, even as large caps did quite well. Will we see more of the same or a more even kind of a market today? First rates on your screen, and I think it should be at about 24,780. That's the first tick on the Nifty. A full 1% cut, 250 points. The Sensex is down about 0.9%, 700 points lower, 81,100. Bank Nifty is down about 0.8, 51,150. Bank Nifty, of course, has been weaker, much weaker than the Nifty for weeks now. Market breadth, of course, is one way to be expected. 4:1 declines to advances. So that's the picture which is emerging right off the bat. 24,800, a little bit of recovery. So about a 50-odd point recovery already on the Nifty. We'll see. As you can see on that wall, those are the 50 Nifty stocks, and I can see only 2 stocks in the green, 48 in the red. Sonia.
Okay, so in terms of individual stocks, right, Tata Motors is your big loser right now. 4% knockdown over there. Couple of things playing out. One, of course, it's run up a lot. So there's some profit taking. And second, the management commentary is on the cautious side. So, the way forward perhaps could look a bit tricky for them. So that's Tata Motors. Maruti Suzuki is the other one that's down 3.5%. Once again, over there, the auto sales have seen a degrowth, especially the domestic passenger vehicle segment, which is struggling for a while now. That is down about 3.5%. Eicher Motors is down 2.5%. So over there as well, Royal Enfield sales have fallen for the month of July. That's not looking good. So that's your top loser right now yet again. M&M is also down about 1%, but bucking the falling trend otherwise in the auto sector. On the upside, you have HUL, DRL, Nestle and Apollo Hospital stocks, few and far between. ITC is holding up actually, looking not too bad. And in the broader markets, something like a Zomato is the one that you need to look at. I think it's up 6% right now. So 250 on Zomato this morning. And now big volumes piling up on that one. The path to profitability for Zomato has been very, very interesting over the last 1 year, especially with some of its new businesses like Blinkit. So that's something that the street definitely likes. But otherwise, it is a weak opening for the market. There are still some stocks that are bucking the trend this morning. So we've been talking about that ad nauseum, but otherwise, it's a weak opening.
Well, that's right. A few stocks, though, are standing out. SJS Enterprises, the numbers were quite good, and that's the street's reading as well, because in a weak market, that stock's up close to around 8%. So good going on that one. SJS, that's flying away in today's trading session. GET&D, the margins rose owing to better operating leverage as well as select high-margin order bookings. They have a healthy order book as well, which I think is 2 times their trailing revenue. So that stock is locked in upper circuit with a gain of closer around 5%. Cummins India, well, that stock is under pressure. I think it's down close to around 7-8% now. The global parent actually had come out with its set of numbers, and there's a decline in India, power generation business in India. I think the street is reading through that, and that explains why that stock, in fact, is taking a hard knock. It's now down more than 8% as we speak. Metal-related names as well. But yesterday they had some sign of a pullback, but from there, in fact, they did see some selling intraday itself. And now the metal index, global-facing theme, if there's going to be a recession, well, then, in fact, these ones will correct a little bit. And that's why all of them under pressured as we speak. So the start is in the red. Some would say that maybe, in fact, the markets have opened up in that slot, provided we hold on to that 24,700 odd mark on an intraday basis. Maybe, there could be some kind of a pullback from the day's low.
Okay, well, that is on the market overall. But a couple of more stocks that I just wanted to mention that are facing a bit of the heat right now. The Bank Nifty is down almost about 400 points, led by ICICI Bank, which is down 1.5%, and a couple of other names as well. But it's really the auto stocks that are the top losers, top Nifty losers right now. Tata Motors, Maruti Suzuki and Eicher Motors. The Vahan data actually indicates that, it is, there is a slowdown across the board, whether it is in the small car segment, whether it is in the commercial vehicle space, whether it is in electric two-wheelers as well. That is also registrations have been under pressure over the past couple of weeks and months, and that's not looking good. But you have to say that this is a falling market, so maybe there's some profit taking as well that we're seeing right now. By the way, Zomato, just pull that up. I think it's 10% higher now on that stock, 9% higher. What a run that stock has had. In fact, it's doubled in 2024 already, and it's had a dream run, so to speak, on Zomato. There are a lot of bullish brokerage views on Zomato, but I think the most aggressive, as I was saying earlier, is Motilal Oswal. They actually have a target price of 300 on Zomato. The others as well. Bernstein has a target price of 275. Jefferies is at 275 as well. Citi has raised it to 280. So it has been a stellar quarter, no two ways about that. I think the quick commerce business is the one that everyone is focusing on now, and the GOV has been picking up a lot for the quick commerce business. Let's see, the dining out vertical is also something that everyone's looking at now, and the possibility of it getting back to profitability.
Well, there's one large trade that's taken place on Genius Park. Close to around 1 crore shares have changed hands out there. So, there's a big volume spurt out there. I think we should pull up the chart of Genius Park. Very, very large trade out there. 1 crore shares in the first few minutes itself. So, big move out there. A few more stocks actually to note which are doing quite well. JHCL, one of the top volume movers today, that's up more than 5%. Just highlighting this one because, in fact, the markets are under pressure and some of these stocks are showing signs of a bit of outperformance. So that's why alerting on that one. A few other notable movers. JP Associates, big volume mover today. That's up close to around 5% odd. From the lows of the day, there's been a very, very minor recovery because that's the inclination. The first dip has got bought into. Tata Steel has come off close to around 3% from the low point of the day. So that dip has got bought into. ITC started off with a cut of around 0.5%. That's moved into the green. So these are the ones that are contributing in terms of the Nifty. Sun Pharma, by the way, the stock was down close to around 2%. Some of the brokerages had written that the read-through of the numbers weren't as good as expected. But for the time being, that's recovered a good 2% from the low point of the day. L&T Tech, though, that slipped a little bit, now down close to 2%, one of the top losers on the Nifty. Prashant.
All right, well, absolutely. So lots to sort of take in with what's happening out there. The market overall down about 190 points, but there are these bright spots, as we've been highlighting, which I think help. We have Dheeraj Agarwal now joining us, Managing Director at Ambit Investment Managers. Dheeraj, good to have you with us here. Thank you for your time. So I think we should begin with a quick view on the globe, and there are doubts whether this is going to be as nice and gentle and soft a landing in the US, because that is the big driver for the global markets because of data last night. But as someone earlier was pointing out, just 1 or 2 data points right now. We get the jobs data later today, but in any case, the overwhelming driver, dominating driver in India has been domestic inflows, which has helped us paper over everything else. So where do we stand according to you, Dheeraj?
So I think, we've been all looking for a correction for a long time, but it's just not coming. And despite liquidity and flows, corrections do happen in the market. We also see one once in a while. Last one was a little while ago. The last 10% correction was, I think, March 2023. So it's about 15 months ago. So one correction is around the corner. The trigger could be anything. And, if something goes wrong globally, it's quite possible that retail inflows temporarily can just take a little bit of a halt or a little bit of a pause. People might just actually want to wait for a month or two before they start deploying capital into the market again. And that's enough at this point of time for a correction to happen. US is decidedly looking a little weak at this point. In fact, contrary to what the popular perception is, 80-90% of the time, the first 1 or 2 rate cuts always results in the markets falling. And I think the logic for that is that central bankers are always supposed to be a little behind the curve, a little overcautious in when they start acting. And by the time they start cutting rates, it's already a little bit late for the economy, and some pain is already sunk in. And hence the market falls, and vice versa also, actually. So I wouldn't be surprised to see a slightly more meaningful correction in global equities at this point.
The meaningful correction has to come, right, at some point in time. It hasn't come yet in, I think, over 1.5 years. So perhaps the time is ripe. But what do you do in such a correction is the question. Do you buy the dip now? Do you wait for a bit? Do you raise your cash levels? Dheeraj, what's the best way to approach it?
I think that's, there's no one clear answer, right? It's horses for courses. So, I mean, I run a long short fund, so I will go short. That's one extreme. But at the same time, if somebody is running a completely long biased portfolio, you could possibly raise 5-10% cash, 10-15% cash, but nothing more. Because I think longer term, structurally, the story is intact. We are still in a rising market. It's still a correction. It's a correction. We have sort of forgotten about the fact that the corrections do happen, and we might be heading into one. And remember, Nifty is just down 1% today, right? Yesterday it was all-time high. So at this point of time, from an Indian point of view, correction hasn't even started. So yeah, a little bit of cash, a little bit of waiting. That's probably the right approach.
If we get a correction, Dheeraj, how much do you think we could see a correction? Because there's plenty of money waiting on the sidelines, and it's been gushing in. So what would your best guesstimate be?
10% odd, approximately.
Okay, from these current levels. And Dheeraj, I wanted your view on one stock. Any guesses for which one I'm going to ask you on?
It's 8% up today, so you know the answer.
But what's the view at current levels? Zomato has worked well for you. Every single time, whether you visited our studio or in fact we discussed, we tried to squeeze it in. Off late, you've not been commenting too much on Zomato. But at around 250 rupees, what's in the price? The best is in the price, or the best is yet to come?
You can't say best is yet to come, but the metrics for this company keeps improving. So I mean, it's a huge market, right? And every time one thinks that, I mean, initially we used to think that food delivery is a value creator, and Blinkit could be a liability, or Blinkit could be a little bit of a value destroyer. Looks like Blinkit is coming back very strongly at this point of time. It could be a value creator going forward. So different engines are firing, and off late I've noticed in most of these delivery apps, including Zomato, is that they keep raising their delivery charges a bit by bit, and nobody's complaining. This is a very different India. This is very different from India of like 15 or 20 years ago, where $1 delivery cost increase or $2 delivery cost increase, there were 3% price increase. People would just switch out from one to the other. I think people are just getting used to convenience, or people are getting lazy, whichever way you want to look at it. There's a lot of stickiness and network effect factor. And hence price increases are easier to pass through. So I think the story just keeps getting better and better. How long? Let's see.
Okay, I think there's a big market, right? But there are also many strong players in this market, whether it is Swiggy, Instamart, whether it's Zepto, whether it's Blinkit. So the fight is on, but I completely agree. I mean, people are getting used to this kind of treatment, this kind of service, right? Quick service, and it's only going to get better from here. But, I wanted your thoughts also on how to approach the auto sector, because there's a lot happening there. There's the Ola IPO that opens today. There is some weakness that we're seeing across most pockets, whether it's passenger vehicles, two-wheelers. Are you cautious here, or would you look for opportunities?
It's autos is a little bit of a mixed bag for me at this point of time. Few segments are looking slightly toppish. I think two-wheelers at this point of time is looking slightly toppish. On the other hand, tractors are improving, SUVs continue to do well. So there's so many diverse businesses within autos that it's difficult to actually take one common brush call within autos. Maruti did fantastic numbers 2 days ago. And the current global trend is becoming clearer and clearer that it's more hybrid rather than EVs. Suddenly Maruti is looking very smart in hindsight. So there are pockets of strengths and pockets of weaknesses within the auto space. So one will have to pick and choose.
Another space is a small space right now is wealth management. I think we've discussed this before. It just struck me because you said it's a different India, and and it maybe richer India in time as well, right? Stocks have done very well, the 3 or 4 which are actually now listed, standalone wealth management firms. Your view, Dheeraj?
This is again a space which has a long runway of growth. So, I mean, at this point of time, if you think about it, only 8 or 9%, it's below 10% for sure, of domestic household savings stocks are in mutual funds, despite the fact that equity mutual funds have grown at a CAGR of 37% for the last decade. I mean, US is close to 40. I don't think we ever reach there. But even countries like Brazil, China, and many of the other Southeast Asian countries are closer to 20. So 10 going to 20, given there's large, and this is not annual financial savings, it's stock of financial savings or stock of household savings accumulated over generations and years. So there is a long runway of growth here. I think there was, and again, a bit of a Zomato kind of a story works here. We have come out of a phase 15 or 20 years ago where people didn't want to pay for advisor service. I think people are willing to pay now. I know of a few wealth management firms who are making it a success, even on the advisory model, which is saying that since we work for you, we won't charge the manufacturer, we will actually charge you, and people are willing to pay. So that's also a sign of changing India, that we are willing to pay for a good quality service and a service which is useful. So this is a multi-decade growth cycle for sure.
Okay, this is a multi-decade growth cycle. Got that. Any other spaces before we let you go? Anything else where you see, certain pockets of strength? We are heading into talking about the real estate space in a bit. Your thoughts over there, or anything else that stands out for you? So, a few boring ones. There's a little bit of what I call the winds of change visible in the market at this point of time. The stocks and the sectors which have done really well in the last 3 years are going into a little bit of consolidation and a breather phase. Stocks and sectors which were gross underperformers of the last 2 or 3 years, few of them are showing signs of a comeback. So on the comeback trail, we have IT services. Most of the results this quarter were better than expected. Now they may be marginally better, they may be a lot better, but then all inflection points are tiny in the beginning. I hate to use that cliched term, but green shoots is what it is. There are signs of revival. Second is the rural demand story. A lot of companies' guidance in this quarter or commentary in this quarter with respect to rural demand has been very encouraging. So that's another space to watch. Third is chemicals coming out of, again, a multi-year consolidation. So there are these individual sectors and pockets which are coming out of long-term consolidation. If you notice, I didn't mention private banks. I'm still unsure of that as to if there is a big upside there or not. Okay, we'll leave it at that. Thanks a lot for joining in, and have a great weekend. We'll touch base with you again later. For now, the market it's not bad, to be honest. I mean, yes, it is down, but it's not more than a % cut or anything. It's down about 0.7%, I think, which is par for the course. The Bank Nifty, in fact, is barely down about 0.4%. So fairly resilient, you'd have to say, despite the weak global cues that we have. Now, DLF is one, stock that we're looking at this morning. Very strong bookings coming in for their new product launch, Privana. Q1, went up almost 214%. Privana clocked in 5,600 crores of new bookings. And of course, this is the luxury real estate space, which has been doing extremely well. Ashok Kumar Tyagi, the MD and CFO of DLF, joins us now to talk about that. Mr. Tyagi, good morning. Things are only getting better and better for the luxury or the premium real estate sector. So great to see that. But I just wanted to understand from you, is this project Privana entirely sold now? What is the quarterly run rate that we're looking at from here, and any other big launches that you have planned for the rest of the fiscal?
Okay, so good morning, Sonia. So, Privana is a bigger ecosystem, and I think almost encompassing 116 odd acres. Right now, what's been launched in Privana, and I'm talking of the launches made in December last year and in April this year, broadly 40% of the total Privana FSI has been offered for sale, and that has been sold 100%. We will at some stage, maybe towards the later part of this year, maybe around Q4, get the next phase of Privana or a similar product, which is broadly a product in the 7 to 8 crore sort of price range. So there should be one more round of this product or a similar product in Q4. We have launched, the point on launches, we have a launch coming up in Goa, hopefully this quarter if all approvals go through. and we should have at least the soft launch of what we call the Lux 5 or Camellias 2, basically the next super luxury project on Golf Course Road. Again, hopefully early part of next quarter. And Mumbai should also happen, I think, in the December/January timeframe. So I think by the end of this year, we'll have these 4 major launches, and of course smaller launches in terms of a couple of launches in Chandigarh and possibly a small commercial plot launch in Gurgaon.
So Camellias 2, how much will it contribute to your sales in this fiscal? You're expecting to launch it in Q3, I assume.
Yeah.
I think the sales potential was 25,000 crores, but in this year, how much could you recognize?
So look, I mean, taking and of course the Camellias experience may not necessarily hold, because the Camellias unfortunately did overlap the entire sales cycle with those 2 or 3 extremely poor years. But we expect that the Camellias 2 overall sales cycle of the 25,000 crores should be approximately, hopefully, a 4-year sales cycle, everything else being fine. I mean, this year, in all fairness, in the 17,000 crore guidance, Sonia, we have kept only a small portion of Camellias 2. So let's see how that pans out. But right now, our plan for for this Lux 5, as we call it right now in the working title, our number will be in the range of 3,000 to 4,000 crores is what we are looking right now. But let's see how the traction is. And again, this will have to be a very calibrated sale, because you are talking to a very discerning set of customers.
Mr. Tyagi, hi, morning. So just a quick point on prices themselves, and we'll go micro again, but slight macro. The prices have done so well, right? I'm talking about real estate prices, and it's in pockets like Gurgaon. I'm not talking about DLF in particular, because you're on one end of this sort of premium segment, and you said, I mean, discerning set of customers, etc. But the price appreciation and the activity we've seen, the transaction activity we've seen, many have pointed out that especially the Gurgaon market perhaps is kind of becoming a little too frothy and speculative. I just wanted you to respond to that. I mean, the percentage of end users are going down, percentage of sort of brokers and investors that is rising. I just wanted you to address it, sir. You'll have the best view.
Okay. On a lighter vein, I tell the analysts also that people in Mumbai just can't seem to reconcile that Gurgaon is doing so well. Having said that, I don't think it's frothy, really. But yes, okay. So let's come to the serious question on pricing. Look, the pricing in the secondary market and the pricing across most established players, as long as their location, their infrastructure are strong, are definitely on the upswing. I don't think there's a out on that. Whether that will start sort of becoming more, plateauing at some stage. I think at some stage, obviously, the pace of growth will begin slowing down, but that doesn't seem to be happening right now. I mean, we launched Arbor in about 15 to 16 months back. Then we launched Privana, which we had thought would be a slightly farther location, almost at the same price point as Arbor. And the Privana 2 location, the Privana 2 launch was also at a price point slightly premium to Privana 1. And the market seemed to be holding. To your point about this, investor wala piece, I mean, in all fairness, the only hard data point that I have is that in the stuff that we have sold in the last, I'd say, 3 years, the requests for transfers or secondary trades that we have got is actually very minuscule. So people are clearly holding on to the projects that they have purchased in. I'm sure at some stage, some people may want to book profits, but this is not those frothy 2008 days where you book a project, pay 10 lakh rupees, and then in 6 months you swing it by for making a 10 lakhs profit on 10 lakh rupees. One more thing, Prashant, as I mentioned, I think on my last interaction with you also, is that we have now, to reduce this froth further, we have upped the booking amount to 50 lakh rupees for normal Privana products. Obviously, for the Lux 5, it will be significantly higher. But the conventional 10 lakhs booking amount hota tha, we have now moved to the 50 lakhs booking amount to honestly filter out the non-serious speculators. And we continue with that entire thing of one allotment per PAN card. So I think clearly, obviously 100% of the buyers are not end users, but I don't think there are any short-term speculators here. There are people like the NRIs who now contribute almost a quarter of our total customer base on these new launches, who I think are taking it for a medium to long term. And I think that's what we are seeing right now. So right now, to sum it up, I don't think we are seeing necessarily a softening in prices, but we are trying our best to avoid the blind speculators. The last thing about the Gurgaon market is that, say, unlike Mumbai and all,
Sorry, go on. Please finish.
So, I mean, I think in Gurgaon specifically, the number of credible suppliers offering products is also reduced significantly, compared to what it was in the early 2010s. We are now a fraction of those, so it's only a few of the credible players who are really offering this stuff out there. So, demand has bumped and the credible suppliers have sort of shrunk, is what I'll say.
But you are at the margin. You are saying maybe some softness should be expected. I mean, the pace of appreciation should perhaps going forward. You're not seeing it now, but it can happen. Is what you're?
Yeah. So look, if you take the Gurgaon price movement, say in a 10-year cycle, actually the CAGR will be very in the 10-11% point. But there was a 6-year time when actually there was virtually no movement. So in the last 4 years, there's been like a bottled up movement. I think at some stage it will start slightly becoming moderate. But I think, even today, it's not that it's 30% a year or something. It's still in the possibly the 10 to early teens.
And again,
it's selective.
Yeah. The point about Mumbai analysts not being able to, the Mumbai analysts all hold stocks in Gurgaon real estate companies, so I think they are participating in the upside. On a lighter note. Oh, sorry. Go on.
Mr. Tyagi, just wanted to ask you one question. In this recently concluded budget, there's a big debate whether in Mumbai or in Gurgaon or any part of the country, whether or not this pulling out of indexation and lowering of LTCG, what kind of impact it can have on the real estate market. I wanted your comment.
Okay, so Nigel, this is frankly, I think I was on the sister Hindi channel the day after the budget, also explaining this to Anuj and team. My view is that whatever maths we have done, and this back of the, and I'm not commenting on the series of tweets that the income tax department has issued out. But I think we believe that if your property was brought in the last maybe 8 to 9 years cycle, and if in the 9 years if it's gone up by 2.5-ish times, I think you are okay to marginally better in the new regime. If it was actually an old property which has say gone up 20x or something, then obviously you would be hit slightly by the newer scheme because of the indexation. Look, on the maths of it, you can't fault the taxman for two things. A, he has reduced the entire rack rate from 20% to 12.5%, which I think you will agree is favorably compares with almost any of the long-term capital gains in the world. B, it has made the entire process simpler going forward. Otherwise, everybody used to keep on thinking indexation. Everybody will try to push the transaction from 31st March to 1st April so that they can get one more year of indexation benefit and all of those things. I think it's a move towards what the FM has been saying for the last couple of years of lower tax, more moderate tax rates and simpler tax regime with limited exemptions. Yes, I think there will be some individual cases who will feel let down by this in the short term, but I think the market, frankly, is reasonably robust enough to be able to take it in its stride.
Don't you think for new sales, Mr. Tyagi, and this is there was a lot of discussion for new sales, 12.5 instead of 20% actually helps in the minds of anybody who wants to purchase?
No. Look. If you were to sort of split the constituencies, I think for the organized builders this is a positive. If at all it's a matter of concern, it's for select wealth managers whose clients may actually sell out slightly more tax in the short term. But actually, because second issue kya hai, ki without indexation now, frankly, the only credible method of sort of avoiding long-term capital gains if you're selling a property is to reinvest back in the new property, and so that you can avail of the 10 crores exemption. So in that sense, this is also a positive for at least the organized real estate for sure.
Just to come back to specifics, the Tardio project with Hubtown, is there an update that you want to give us?
No. So as you know, I mean, it's gone into a huge legal battle with Uptown. So there are multiple forums in which we are currently engaged in. So let's see how it goes out. But I think clearly it has gone. I mean, we feel that the way it spanned out was not the best way, frankly, and it's now gone, unfortunately, into a huge legal battle between Uptown and us. Yeah.
All right. Thank you very much. Appreciate you joining in, and good speaking with you, Mr. Tyagi. And we'll chat again. But that's a good update. We'll take a quick commercial break here. We have the management of GE Shipping joining us on the other side to discuss their first quarter earnings. Stay tuned.
Welcome back. Well, let's focus on another stock that's done very, very well, GE Shipping. Well, the quarter one numbers, we saw good growth in revenue and profits. Margins as well are holding around the 60% for the second consecutive quarter. To understand the way ahead, we're joined by Mr. Shivakumar, the ED and CFO of the company. Hi, Mr. Shivakumar, and good morning, and thanks a lot for joining in. Well, prima facie, it appears that spot shipping rates are softening a tad bit. Could you comment on that? And also, if you could give us the split between spot as well as longer-term charters.
Good morning, Nigel. Thank you for having me. In the last quarter, if you're referring to the last quarter, yes, we had a slight drop in crude tanker rates vis-a-vis the previous year, corresponding quarter in the previous year. But we had product tanker rates being higher versus the previous year. We had bulk carrier rates and our gas carrier earnings being higher versus the previous year. Currently, rates are significantly lower than they were in the first quarter of an FY25. This is likely to be the usual summer lull. Tankers traditionally have been weak through the Northern Hemisphere summer months, especially July to, say, October or so. So currently they are weaker than that also. We don't see this necessarily as an indicator of rates to come or the strength of the winter market for tankers. Bulk carriers, of course, are stronger because they have the opposite seasonality. In general, on the fundamental side, we are seeing a slight drop in demand growth for oil being a little lower than was expected at the start of the year. China was pretty weak in the last quarter in terms of crude oil imports. These are slightly worrying signs. But again, we see these ups and downs even in the midst of a strong cycle. So we shouldn't read too much into it.
Okay, all right. And since the order book, is still low, I think, that should support the rates in a longer term, say for the next 2 to 3 years, or that's what, most analysts are saying. Also, the split between spot as well as longer term, what is it at currently?
Yeah, so it depends on the sector. In dry bulk, we are 90% plus spot. In LPG, we are 100% fixed. We are on 1 to 2 year charters for all 4 of our vessels. In crude, we are 100% fixed. In product tankers, we are about 30% fixed on our fleet. And when I talk about fixed, I'm talking about for the next 12 months.
Sorry, let me just get that again.
Exposure. Even product tankers, while it's 30% fixed, the product tanker fleet is very large as a proportion of our total fleet.
I see. Just to go back to Mr. Shivakumar, hi, good morning. Just to go back to that slight drop in demand that you spoke about, last night we got the we got PMI numbers, and it's an early indicator, and it seems to be the first kind of synchronized slowdown in global manufacturing that we are starting to see. First signs emerging. So are you picking that up as well in your conversations, etc., or too early?
Yeah, the data we've seen, and also because China is one of the big factors in commodity imports, where we've seen data for China specifically, and we can see it, we track it through the import data itself. And as I said, crude imports were down about almost 1 million barrels a day year on year. It's about 9% year on year into China. Steel production has been lower, so that's affecting the dry bulk. While iron ore imports were pretty strong, we are seeing steel production being slightly lower, and in fact, exports, consumption being even lower than production, which meant that there were steel exports coming out of China. So all of these are a little bit negative for the markets in terms of the underlying economic strength or the which could drive the markets.
And how important, I mean, China, of course, from a commodity point of view, is the single biggest incremental driver for shipping rates, and for your business, what would sort of further weakening of that market mean?
Yeah, so just to put it in perspective, 40% plus 44% of dry bulk trade is China related, which is either imports into China or exports from China. 20% plus of the crude tanker trade is imports of crude oil into China. So this is a very big factor. And as you know, we live and die on the margins, that 1 to 3% margins make a big difference on demand-supply balance, make a big difference in the rates that we earn.
Okay, all right. Wanted the updated pricing on rigs as well. I think, there is one, or I think there are a few more actually that have to come up for repricing. So could you break that up for us? How many have already come up for repricing? And how many will come up? And how much is it likely to be repriced at?
Yeah, so first, the last question. It's a tender business, so we don't know what they'll be repriced at, and it's tough to forecast. But we had 2 rigs coming up for repricing in the second half of calendar 24. So they will come off contract within the next 3 to 5 months. They're coming off 3-year contracts. Both of these were bid into 3-year contracts into India, in India itself. Both of those contracts those tenders have expired with no contracts being awarded. So they've effectively been cancelled. Now we are waiting for the next tender to come out because we assume there is a requirement in India. So we're waiting for that to come out. In the meantime, we're also looking at other options, whether we can do some short-term contracts in India itself. There are other opportunities. We're also we used to focus on doing long-term contracts in that business because we had taken a little more debt in that business than we do in shipping. So we wanted to de-risk that business, at least de-risk that debt. Now we are very comfortable in the offshore business. We are also looking for shorter-term contracts, and we are very comfortable doing short-term contracts as well. So we don't have an update on the pricings. Ever since Saudi Aramco off-hired, I think, 24 rigs in the month of April, May, there has been a little bit of uncertainty in the international markets. However, we haven't seen pricings drop in terms of day rates. So it's still early, and we are not able to tell what could happen to day rates yet.
Okay, well, thanks a lot for that. Appreciate your time here on CNBC TV18. Well, that is the word coming in from GE Shipping. But moving on, Godrej Properties reported a stellar set of Q1 earnings. The company's bookings rose 300% on a year-on-year basis, and the company remains confident of meeting its FY25 guidance. Our colleague Sonal caught up with Gaurav Pandey, the Managing Director and Chief Executive Officer of Godrej Properties, and began by asking him about the likelihood of the company beating the guidance and also on their launch pipeline. Listen in.
We have a very exciting launches planned for the year. As you would have noticed, we gave a launch guidance of about 30,000 crores for the year, 29% of which we've already managed to hit the market with. And thankfully, we are seeing great momentum continuing for us in all the large geographies where we are present. So just to give you a hint of some of the launches that we're looking forward to this quarter and the quarters beyond that, in Mumbai, we had a stellar launch of a project called Godrej Reserve in Q4, which became Mumbai's largest launch ever. And we have very exciting phase opening of that likely within this quarter. And we look forward to some stellar record also in that. Moving up in North, we have quite a few launches planned back to back. We have something coming up in Gurgaon Sector 103. Then we'll have 2 launches in Gurgaon subsequent to that in Golf Course Road. We have something we had acquired from Noida Authority in an auction, which should hit the market later part of this year in Sector 44 Noida. And if we go down south, we have a series of launches planned from Yashwantpur, which is a very important new micro market for us, to something in North Bangalore. Then maybe a launch in Hyderabad, if not 2. And in Pune, again, we have a series of launches planned, from Manjari to Mahinje to Koregaon Park. So very exciting launch calendars ahead. There is a very high degree of probability that we will, of course, meet our guidance. And there is a reasonable probability that we might even exceed our guidance. So, but we're not really changing our guidance. It's too early because, real estate sales are very lumpy depending on approvals. But yes, fingers crossed, we have a very exciting year ahead.
Yeah, it looks like from the numbers. Gaurav, the other thing that is strong in this particular quarter is your operating cash flows. They have surged 8 times on a YY basis. Customer inflows have increased 54% on a YY basis. The spends on land and approvals, they're up 25% on a YY basis. This is to a near record high levels. Tell us, what will these numbers look like by the end of this year, considering that you're looking at a lot of land acquisitions? And what is the collection efficiency right now? Is it better than the industry for you?
Great. That's a great question, actually. So if you look at a journey from a collections point of view, we did about close to 2,000 crores a year back in Q1. As you rightly said, it's grown by 50% to about 3,000 plus crores of collections, which is why our operating cash flows now stands about 988 crores, which is a record ever from a Q1 point of view. And this is all going to fuel our business development opportunities, and we will continue to see great collection curve. Our guidance for the year is 15,000 crores of collections. And collections, you would appreciate, normally, again, is linked to projects which are late stage in terms of completion. You get lumpier collections. So we will have a lot of OCs coming to the later part of the year. So collections curve will, of course, shoot more strongly to the later part of the year. And we are reasonably confident on a guidance of 15,000 crores of collections. With that, I think we have a lot of headroom to do more exciting stuff on the business development side, which is why you saw even 2 announcements in Q1 happening on the BD side, one in Bangalore as well, and one in Pune. So yeah, we will see a similar happening in this quarter. Starting with Indore, we were done already 1 announcement. So yeah, great collections is leading to great operating cash flows, which we are kind of churning back to business development.
So, your debt has still increased on a quarter-on-quarter basis. So, will most of this be funded via debt or internal accruals? Because even your cash flows are strong right now. How do you balance the two?
I think it'll be a combination, right? I mean, we've given for the last 7-8 earnings call, we've maintained that our guidance from where we want to operate from a net debt is to equity is between 0.5 range to 1:1. Right now, in almost the middle of the range, we're about 0.71 by end of Q1. So yes, there is, to begin with, a significant opportunity available within the debt headroom, but there is always going to be more and more operating cash flows available to fuel growth. So it's a combination of when do we want to use which part of the capital to fuel growth. But yes, it's going to be a combination.
Gaurav, we are speaking just after the budget, and there's been that big change in taxation for property sales. The long-term capital gains cut to 12.5%, but indexation taken away. Do you think that is something that could impact sales going forward? Because, it would work only if the price rise is more than 11%, would be beneficial for any seller. And that has not been the case largely in the real estate industry. What do you make of this move?
I think, so let me divide buyers into maybe 2 broad categories. I mean, one can segment the customers into many more categories, but just to make it slightly more easier to understand. Let's say you are a buyer, which is 10 to 20-year-old kind of a period of time. Removal of indexation will probably it may impact you the most, right? But usually if you see people with holding periods of 10 to 20 years are either people who are end users who want to now upgrade to the homes. Usually those are the bucket who hold beyond 10 years as one of those buckets. And these people will be agnostic to the change. Why? Because when you upgrade, LTCG doesn't really impact you because it impacts you if you withdraw. And then the second bucket of investors, which is looking at equity multiple, like wealth creation, generational wealth kind of category of investors. Again, this actually make it a little more stickier to the sector because yes, you lose on the indexation, but the way to prevent is you buy property again. So I think those two categories would have been largely impacted, but mostly 80 to 90% of those are either end users or equity multiple oriented kind of generational wealth kind of investors. On the short term, actually, it might be a bit of a good positive surprise because if you're holding period like this 5, 6, 7 years, generally indexation doesn't make huge of a difference, but it would actually make it either neutral, slightly better in the case if you reduce your timeline to say about 4 to 7 years of investment. Why? Because one, you get the benefit of lower LTCG, and to top it off, this theory in our mind that when we look at asset classes for comparables, we tend to look at equity differently from an investment thesis versus this. Here, actually, have a benefit that it becomes exactly comparable. So your return thresholds to assess risk and reward becomes very easy to do. And on top of it, if at all you feel the cycle is riding on through even 4 to 7 years, you can always prevent capital gains tax by reinvesting the property and take the benefit of compounding, which in many sectors you don't get it. So I think there is a lot of nuance to what people are initially interpreting it. But with time, 6 months, 12 months, you will realize people will understand the meaning of it and it might have a positive impact. At the moment, I would say, given the noise, it's best to assume it's neutral. But I have a feeling that in the long run, when people will understand the logic, it might turn out to be an interesting surprise.
Okay, thanks a lot for that and all the best for the next couple of quarters. That is Godrej Properties. Well, the Nifty is down 270 points right now. So not looking good at all at the moment. It's below, 300 points below the 25,000 milestone. But that generally happens when you hit that, big milestones in the market sort of corrects. And we have global cues as well. Mitesh Thakkar is with us. Mitesh, good morning yet again. This is a market that is now perhaps starting to give you some opportunities to buy the dip. What would you do now and what's the way forward?
Well, I think, the first level of 24,800 isn't holding, which means that we might have a slightly deeper pullback than initially thought. Plus, today we had a gap down which was not filled. So I think all this suggests that we could possibly see the index head towards 24,400, 350 zone. That is where I would want to buy. So wait it out. In fact, I have some sell calls right now. Crypto is looking negative, so sell here with a stop at about 520 for targets of 500. And L&T Finance, I think, that's the other one which I think is slightly on the negative side. So LT Finance is a sell with a stop at about 176 for targets of 164.
Okay, all right. Thanks very much for that. Appreciate it, Mitesh, for you joining us with those trades. More coming up later. We'll take a break. Manisha will be joining in with what's happening in commodities. Stay tuned.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
Welcome back to Bazaar Corporate Radar. For now, we are just kind of, dealing with the markets under pressure, given that we have a very weak global cues. But let's find out what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking?
Thank you for that, Sonia. When I'm looking at the crude oil prices, which also is dealing with statements from the OPEC and allies, the JMCC just had meeting yesterday, and there is no change to quota as of now, and this is on expected lines. But in the meanwhile, you have the crude oil prices declining for a fourth straight week. This is how they're headed for. This week as well, it's down by 1.5%, and this is the longest losing streak that the crude oil prices are putting out since December 2023. For the month of July, then, we are down by nearly 7.5%. After that very sharp cut yesterday, we are trading nearly 0.7% on the higher side. So 80 is back in case of the Brent prices. But the pressure has just about continued because of various factors here. One, when you look at the demand itself, that has been slightly on the weaker side. The global fuel numbers that the markets have seen for the month of July are slightly weaker on a month-on-month and an year-on-year basis as well. And that has been keeping pressure. Apart from that, it is about the manufacturing data that has come in from US, various countries in European Union and within Asia as well, which shows slower number growth on a year-on-year basis. Especially when you look at the China fuel demand, well, that has seen a constant decline. The Asia crude oil imports in the month of July have been the lowest in 2 years. And when you look at the Chinese numbers within Asian demand, we have seen a decline of 11% in the first half of 2024 already there. What the markets will, though, watch out for the US weekly inventory data. Well, that clearly has been on the lower side. That has been some supportive factor there. And then, of course, the concerns of a wider conflict within the Middle East. But for today, it is going to be about the US non-farm payroll data. All eyes onto that one. So for the month of July, while we have seen 7.5% come in for the crude prices on a declining basis, it pretty much has been a similar case for other industrial commodities as well. So for the month of July, we've seen nearly 10% of a cut come in for copper, steel, aluminum. Iron ore prices declined by 2%. But the other metals like nickel, lead also have seen a decline anywhere between 6 to 10% in the previous month. The markets do believe that for this month as well, of course, it is going to be the US Fed meeting and a rate cut on how that comes and the guidance for therein. But at this point in time, the pressure just about continues here.
All right, Manisha, thank you very much for that. Let's put up Zomato. I think it's definitely the high point of the day. And how? I mean, look at that. That's an 18% move. Wow. I mean, that's a 40 rupee move on a 280 rupee stock now. So incredible move. Mangalam is back with us to highlight some of what stood out. I mean, a lot stood out. Mangalam, over to you.
You know what's surprising, Prashant, is the move today on Zomato is 40 rupees. Just a couple of years ago, almost 18 months ago, the stock itself was about 40 rupees. So that's the kind of move that we've seen on Zomato. And it's a perfect, scenario for all sorts of results. If you look at the numbers, streak of good results continue. Brokerages upgrade the stock. Add to that, the profitability of the company. Annualized profits for this year are close to 1,200 crores. And at the same time, Blinkit, which has been the valuation driver and the value driver of the company, they've gone ahead and upped the growth guidance for that as well. And if the street couldn't have enough of that, well, they've spoken about District app by Zomato, which could be their third vertical of growth as well. So overall, reported revenue growth of the company grew by 74%. Food delivery grew by 42% with margins expanding out there. Quick commerce revenue grew by 145%, and on an EBIT basis, it's a gain of 43 crores versus a loss of 105 crores. This time around as well, they're narrowing the losses that they're making in some of their key verticals as well. As a result of which, the brokerages have gone ahead and become positive on the stock as well from already positive stance. So CLSA has raised their targets to around 350 rupees. They've raised their estimates by 6% to 36% over the next couple of years. Motilal Oswal has said that Blinkit defies their attempts to value the stock fairly, and Nomura, Citi, all of them are pretty positive, with both Jefferies and Citi actually looking ahead at what the company does with their going out business. Because in the going out business itself, they've seen use cases increasing in all the way up to sports ticketing, movie ticketing, live performances, shopping and staycations, etc. With this District app that the company is likely to launch, it will address these use cases. The management has said that this could very well be the third largest B2C business emerging out of Zomato. So now the street is looking at Blinkit's example and thinking that if this has to be as big, then maybe they could start ascribing value to that too.
Okay, thanks a lot for that. So that is on Zomato, the big mover this morning. But Vivek is joining in to talk about GR Infra. Vivek, over to you.
Well, that's right. So in line with what most of the infra companies have faced this particular quarter. Remember, this particular quarter was marred by the fact that, number one, it was the summer season, very severe summer. So a lot of execution was delayed. Number two, there was labor unavailability that a lot of the companies faced, and also the election impact, given the fact that election was ongoing, on the back of which ordering activity was not going on. On the back of all of this, most of the infra companies this time around are facing a bit of a slowdown. Number one, both in revenues and also in terms of the ordering activity and therefore the order inflow. Revenues for the company was down 18% on a year-on-year basis, coming in a little over the 2,030 crore mark. EBITDA, down almost 40% on a year-on-year basis, 368 crore mark. EBITDA margins at 18.1 versus 24.5% year-on-year, and profitability down by almost 50%. More details are available, are awaited, given the fact that the company will be hosting their call early next week. But at the end of Q4, this is what the company said. Number one, order book they were sitting on was close to 16,780 crore. So, there is decent amount of revenue visibility. Pending projects, that is where they were, L1 was close to 7,000 crore. And the company said that they're targeting order inflows of close to 15 to 20,000 crore for FY25. We will need to wait and watch whether that is delayed, given that Q1 appears to be quite slow.
All right. Thanks very much, Vivek, for that. We'll take a quick commercial break here. Lata will join in on the other side, and she'll be speaking with Amitabh Chaudhary, Chief of Axis Bank, and they discuss the first quarter earnings from the bank and more. Stay tuned. Coming up.
भूंतर पार्वती और जिया संगम पे हो, जहाँ पर आप देखते हैं कि ये जो रौद्र रूप व्यास और पार्वती नदी का यहाँ पर उफान पर है। हालांकि अब जो है थोड़ा सा पानी कम हुआ है, लेकिन यहाँ पर जो व्यास पार्वती नदी के किनारे जो ये भवन था, निर्माणाधीन भवन है, उसको जो है भारी नुकसान पहुँचा है। जहाँ पर आप देखते हैं कि ये जो भवन का एक तरफ का हिस्सा जो है वो पूरी तरह से क्षतिग्रस्त हो गया है और इस पूरे भवन को जो है नुकसान इससे पहुँचा है। इसके साथ साथ आप देखते हैं कि यहाँ पर जो है भूंतर के पास जिस तरह से यहाँ पर सुबह के समय जो ये बाढ़ का जो मलबा और जो गाद है वो यहाँ पर सड़क तक पहुँच गया था, जहाँ पर सड़कों में आप देखते हैं कि यहाँ पर भी मिट्टी और गाद जो है पूरी तरह से भर गई है। और सुबह के समय यहाँ पर बड़ी संख्या में जिस तरह से लोग जो है यहाँ से प्रशासन की तरफ से लोगों को अलर्ट किया गया था कि लोग जो है वो अपने सुरक्षित जगह पर जाए, क्योंकि जिस तरह से मलाना डैम जो फटने के बाद पार्वती नदी में जो रौद्र रूप था, जिस तरह से भारी बाढ़ जो है यहाँ स्थिति यहाँ पर उत्पन्न हुई थी, चाहे वो जिया गाँव की बात करें या फिर भूंतर के आसपास की बात करें, तो इस सड़क तक जो है पानी बह गया था। आप देखते हैं कि यहाँ पर भी जो है मिट्टी और गाद भरी पड़ी है।
Welcome back. Now it's time for a very big conversation. Banks have been having a tough 2024 with a virtual war for deposits, even as pockets of NPA stress have started opening up in microfinance, in unsecured loans, as the Reserve Bank was alerting. Now, of course, Axis Bank results reflected some of these issues. The bank's slippages did rise, and their provisioning, or what you call credit costs, have also risen. Reserve Bank is now likely to make it even tougher for banks by asking them to hold more money in liquid assets like government bonds. That is, the LCR ratio is going up. So, how's the year ahead looking like? I have with me one of the biggest bankers in the country, Amitabh Chaudhary, Managing Director and CEO, Axis Banker. Good morning, Amitabh, and thank you very much for your time. But let me start with something hopefully pleasant. You saw the events overnight in the US. We saw very bad manufacturing numbers, ISM manufacturing numbers, very high jobless claims. And therefore, now the bond yields over there have crashed below 4%. Do you think we are inching closer to a rate cut in India?
Well, we have been hearing about rate cuts in the US and the global economies for quite some time, and it's been a bit of a journey, rates being cut, rates going higher, rates remaining the same. Our view, and I think a view which we've held quite steadfast over the last 12 months or so, is that I think the rates in India will remain high for longer. I'm not saying they'll go higher, but they will remain high for longer because the drivers for India, apart from what's happening globally, also is that, we need to continue to tame down inflation. We're still not at the 4% target. While, as you rightly said, some of the numbers in the US are not looking very good. At the same time, we cannot forget the fact that the global political situation remains quite volatile with what is happening around the world. So, and I think India will and can get impacted very quickly given, the import of oil and so on and so forth, and Middle East remains a hot spot. So my view is that while these numbers do indicate that the Fed might have to act or do something faster than what we expected earlier, but will India immediately react and do something here? I think RBI will take stock of the whole situation and move quite deliberately, but not in a hurry whatsoever. So my view is rates will continue to remain high for longer.
Yes, actually, we had Neelkant on the channel yesterday, and there is this big worry that a Trump win might mean higher tariffs, and that can push inflation higher in the US. Okay, that's another topic altogether. But just coming back to this scramble for deposits, do you think it's time maybe the Reserve Bank thinks of a CRR cut?
Well, you have to look at the recent draft circular on LCR, and on the top of that, if I say, oh, by the way, on the side, please cut the CRR. I think they have to look at the whole situation, and I'm sure they are, quite holistically. On one side, they are quite worried, and they've been talking about it for some time, that given some of the events and how they played out in US, with SVB and some of the other banks, they have on one side talked about, you mentioned in your opening comments also, talked about a higher LCR and what it could mean in terms of the amount of assets the bank has to hold as HQLA. That's one side of the story. On the other side of the story, the deposits remain tight. What are some of the actions which Reserve Bank of India could take to ease the deposit situation? My view again, and again, I'm no one to predict what RBI will do, but the LCR move is going to take an excess demand for HQLA of 4 to 5 lakh crores. And frankly, if you just do the maths, the number could be obviously much higher, close to 7 lakh crores. But, one is assuming that people or the banks will dip into their excess HQLA and only buy as much as what might be necessary.
Exactly.
So on one side, we have to put in more money into HQLA, and it will have, if nothing else is done, if banks absorb everything, it will mean obviously an impact on margins for all the banks, anywhere between 5 to 15 basis points. And this is also assuming RBI will do exactly what they have said in the draft circular. On the flip side, if banks, could decide to pass on some of this impact to the customers, either in form of higher charges or in the form of higher rates, or hopefully RBI will not do exactly as what they have said. So let's see how this plays out. CRR cut is only one of the things which is things which are available to RBI to manage this on the other side. But let's wait, because I think they're quite open to listening to feedback. They're listening to feedback. Let's see.
Okay, no, I just want to tell the viewers who aren't so keen into bank balance sheets. At the moment, banks have something like 25-26% of their deposits in government bonds, what Amitabh referred to as HQLA, high-quality liquid assets for their liquidity coverage. And then they have another 4% money in CRR. So already nearly 30-31% has been impounded for the statutory rules, and another 2% more on PCR, on provision cover, will mean that 1/3 of the bank balance sheet goes away and is not available for lending, and maybe the Reserve Bank will think through that. But Amitabh, what are your own numbers?
I'll just add that if it is implemented as is, this will be equal to what existed in 2008, when SLR and CRR requirement was 33% of NDTL. So just to do a comparison.
That's some perspective. I remember 9% CRR under Dr. Reddy. That was the last decision he took. But Amitabh, what is your own liquidity cover ratio now, and what do you see it under current RBI draft rules?
Well, we have not given any guidance on that because we are waiting for RBI to first finalize these rules, but we have been maintaining our LCR around 120% forever, including during the COVID period. We have enough cushion available from what RBI expects us to maintain it at. So you would expect us to be in the 115 to 120% range. Obviously, it's a dynamic number, but that's what we would like to maintain. Please understand that LCR is not the only number which we have to take care of. LDR is another.
Yes.
RBI has been driving quite actively over the last couple of quarters. And as we have stated in our calls, we have a clear strategy outlined. RBI has seen that strategy, is broadly okay with it, and we are continuing to implement our deposit and our advances kind of growth under that strategy, which has been obviously signed off by the board and RBI.
In your latest numbers, your advances growth is faster than your deposit growth, I think by 1 percentage point. What kind of growth forecasts are you looking at? Will you look at lowering your loan growth? And if you can also guide us on, therefore, what margins will you be able to keep to the 4%?
So you raised a couple of questions. One, as you rightly pointed out, we have been saying, I think for the longest period of time, that the deposits and the advances growth does need to converge. They can't be running, the credit growth can't be running way ahead of deposit growth. And again, we have been saying that that number will be most likely close to 13% for this financial year. So we have maintained that stance, I think, quite consistently. We have also said, as Axis Bank, that we believe in the medium term, we can grow our advances at the rate of 300 to 500 basis points higher than the industry. Now, that is medium term, but it's not for this year. Obviously, it is not possible unless our deposit growth also is in line with that advances growth. Yes. I mean, because of all the things which I've said, it is obvious that we are in a way saying that the deposit growth would be similar. So, so that's on the deposit and the advances side. As far as the margins are concerned, again, we've maintained a consistent stand that on a kind of through the cycle, we would like to maintain NIMs at 3.8% and above. We have been able to maintain it 25 basis points over 3.8% consistently over quite a few quarters. And obviously, we'd like to keep this cushion as much as possible. So what we are saying is hold us against 3.8%, but we are striving very hard as an organization to ensure that we maintain this cushion of 25 basis points, which we have been delivering quite consistently for some period of time. Now, obviously, some of these new things which are coming up could have an impact, but let's see ultimately what the final shape of the guidelines are.
Okay. Well, as a bank within the top 5 in India, what's your sense about deposits itself? Do you think they're going to get even costlier before they start declining? Before the cost of deposits start falling?
Well, we are living in a very clearly a deposit constrained environment. And it is quite clear that there will continue to be intense competition for deposits. You will see some institutions managing that intensity in the short term because they have some specific context. Some of them obviously will play the long-term game. As far as Axis Bank is concerned, we have been driving a granular transformation project on the deposit side for quite some time. As we have again mentioned in our calls, we are seeing some green shoots, but it's a ship which you're trying to turn around in a certain way. It does take time. We believe that while we are doing that, we also have to do the right thing. So you are aware that in terms of outflows on the LCR side, we have brought down our outflow rates by 400 basis points over the last 2 years, which places us among some of the best banks in terms of the overall outflow rate. So we have been slowly, gradually making a lot of changes in our deposit franchise, which might not be visible to the naked eye. But our view is intensity will remain. Our view is in the short term, some players might do things which, obviously will give them some deposits in the short term and I'm not questioning what they're doing. They might have their own context. We are trying to drive a very, very long-term strategy here. We believe that's the only way to set our ship right. We have been on this journey for some time. We are quite happy with the progress we have made, but we still got a long way to go. And that's exactly what we are striving for across various parts of this.
No, 4%. I just wanted your NIM's view.
Oh, well, I said that, we'd like to maintain that cushion to 25 basis points, about 3.8%. So we're trying and striving hard. I'm not trying to give a guidance, but obviously the organization is quite focused on NIMs. And, especially when your deposits are constrained and you are having a risk-adjusted return on capital kind of model, so then you do need to drive a certain waterfall. Obviously, keeping some of the risks which are emerging also in mind. So I'm not saying it's impossible. It is tough, but it is possible at the same time to be able to maintain this cushion or be in the zone of that cushion for some time.
Yeah, no, I mean, at the moment, volume of loan and margins are both highly in a highly competitive zone, and hence the pressure.
That makes a job quite exciting. So that's okay.
Exciting, challenging, tough. Yes. Okay, Amitabh, credit cost. That was the big worry for analysts, and everyone has chosen to comment on it. You had said that you would be able to improve recoveries, and that will bring down the overall situation. Can you just put some numbers to this? What may you end up in terms of credit cost? What may you end up in terms as recoveries in the current year, FY25?
So if you just give me a couple of minutes, I would first like to provide some pointers on the trends visible at the industry level. We are seeing increase in credit costs across the retail unsecured portfolios at the industry level, which is to be expected, something which we've been talking about, given that you can't remain at trough levels on a through cycle basis. We have also seen a slight increase in delinquency at industry level based on bureau data, especially for personal loan and cards. So the reason, and if you look at the recent Q1 results commentary from banks and NBFCs, they have also highlighted that the normalization trend in slippages, credit costs, with slowdown in recoveries and upgrades, and some pickup in stress and unsecured loans is visible, and they are also all tackling it. Now, as far as coming to Axis Bank, we believe that the credit costs for the system and for us cannot be at the levels they have been in fiscal 24. They need to move up, primarily driven first by slowdown of recoveries and upgrades, which we are starting to see. So we have been saying this forever, that the credit costs will normalize. They may not normalize to what we have seen in Axis Bank in the past. It will be quite lower than that, but they will normalize first. We are also seeing increase in credit costs across, as I said, retail unsecured portfolios, which is expected given it can't remain at the trough level. So we have been taking proactive risk action for close to 6 to 9 months now and working within the defined risk guardrails which we have for the bank. We continue to monitor our retail unsecured portfolio. We believe that the calibrated actions that are being taken will play out over the next 3 quarters along with other actions that we are taking, and we will show improvements. So while we do not provide guidance on credit costs, let me definitely say this. While our first quarter net credit costs in 90.97 basis point, 95 basis point, not reflective, and let me repeat, not reflective of full year credit cost expectation, as first quarter credit costs is impacted negatively by certain timing differences. And obviously, apart from the timing differences, we expect some of our actions to bear fruit, not immediately, but over a period of time. So yes, while the first quarter had, firstly, the seasonal effect, the first quarter had some timing differences, and the first quarter had the impact of, anyway, the fact that the recoveries are, reducing and that you are seeing some deterioration in the unsecured portfolios. But we are hoping that over a period of time, we can, get the ship moving back in the right direction.
Okay, just one final question, because there is a gun to my head on commercials. Do you see more OPEX control? I mean, you surprised us with a lower OPEX. Do you think that there are more synergies now with the Citibank, that card portfolio in the max sales on? Do you think you will be able to reduce OPEX and increase fee income?
So I think as far as fees is concerned, if you look at our fees to retail assets, we are one of the best performing banks. So there is little leeway left in continuing to juice that franchise. I mean, as we grow, fees will grow, but nothing beyond that. As far as OPEX is concerned, yes, we've been investing a lot in some of the specific areas we've identified, IT, analytics, digital. We're also running various transformation projects. We obviously want to see the benefits of this to play through. As the overall advances slow down or they are lower than before, we do believe that over a period of time, we should be able to continue to manage our OPEX as we move forward. And I think we have demonstrated that in the first quarter. Please also realize that we will get some benefit of the fact that now the Citi acquisition is over. We were incurring one-time costs every quarter to support the the Citi systems, and there's some payments going out. That will all stop now, but amounts are not large, but they will definitely help us in reducing our costs, at least from the base level perspective.
Okay. Out of time, Amitabh, but not out of questions. I'll take a rain check from you for a longer chat sometime. Thank you very much.
Thank you so much, Dada. Always a pleasure. Thank you.
Okay, we are wrapping up on Bazaar on that note, and also on the note that the markets have shown some bit of recovery from the very steep losses we saw about around 10 a.m. Let's see whether we have seen the bottom for the day. We wrap up on Bazaar. Chartbusters coming up.
We've always grown ahead of the market, Rima. And when the market was growing at 30% 2-3 years ago, we were growing at 50%. And last year, when the market, we feel, grew probably like high single digits or low double digits, we were higher than that also. But at the same time, I think it is important to note that this is a business which has very high operating leverage. So even though that the revenues grew 15%, the PAT doubled in a year. And that demonstrates the strength of the product and the high margin nature of the business. So even going forward, we anticipate that as revenues grow, the profit should grow almost disproportionately with revenue growth.
So to your mind, what are the steady state operating margins?
Most SaaS companies in this space tend to operate around 25-30% margins at steady, EBITDA margins at steady state. We do anticipate at some point we'll also get there. However, it is important that we are taking a cue from your earlier question to Kapil. We are still in the very early days of e-commerce in India. I remember 10 years ago, when I started my journey in e-commerce, people used to say nobody will buy anything online. Then they started buying phones. Then they said, oh, but they will not buy apparel online because, the fit is important. Then people started buying apparel. Then they said, but they will not buy shoes for sure. And then people started buying shoes, and then beauty, and then pharmacy products, and then, even grocery and food, everything. So we have always been surprised.
Tata Motors skids more than 3% on the back of quarterly results. Although the numbers beat street expectations, the company's global outlook and, JLR's commentary remains cautious. The stock now down 4%.
Eicher Motors and Maruti, they too skid post weaker July auto sales data. Total domestic sales for Maruti declined by around 5.3%, while Royal Enfield sales for Eicher Motors came in lower by 8%.
Cummins India declines on the back of negative commentary from the global company's parent. Cummins Inc. says that the revenue for 7 entities in India, including 3 JVs, saw 10% decline year-on-year.
Zomato zooms more than 10% after delivering a good quarter. The revenues jumped by 74% from a year ago. Brokerages also issued bullish calls on the stock.
Weak results coming in from Pratap Snacks and Somani Ceramics, pushing the stocks lower. EBITDA declined 8% for Pratap Snacks, while EBITDA for Somani declined by about 3.5%, citing seasonality challenges in the first quarter.
Hello and welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. Well, the screen is red, but I think it's not as bad as feared, because in the first 90 minutes or so, the breadth of the market actually has improved. When we started off trade, there were 300 stocks that were advancing. Currently, you have close to around 800 stocks that are advancing, so those crisscross lines are getting a little bit closer to each other. And big boy HDFC Bank that we pointed out earlier today as well. Yesterday as well, it came to life in the final hour of trade, and today as well, that's at least holding one end up. Mangalam.
Absolutely, Nigel. It may have the tailwind of the impending flows of the MSCI as well sometime in this month. So that is something we'll keep an eye out on. Of course, the stock had rallied before the announcement all the way up to 1800. That time it was, an overheated trade, all of that. Thereafter, we had the numbers, the update, etc. Went all the way down to 1600. And from there, it's seen a bit of an up move that we're seeing as well. The broader market is doing extremely well, not only as Zomato, the holding company of Zomato, Info Edge too, has surged to the high point of trade with a gain of almost 5%. Granules, India Cements, Oil India, NBCC, a lot of the stocks in the broader markets actually doing a lot better. Private sector banks, along with HDFC Bank, we've seen Kotak Mahindra Bank move higher as well. So keep an eye out on that too. So let's talk about a lot of these stocks which are in focus. One of them on our radar is Redington. The company reported weak performance in the first quarter. The revenue declined by about 5% sequentially. We do have with us V.S. Hariharan, who's the group CEO of the company, joining in to discuss the numbers in detail. Thanks a lot, Mr. Hariharan, for joining in. One important question is with regards to your revenue itself. The first quarter revenues were weak. What do you attribute this to, and will you see an expansion in the second quarter? I mean, you said that there was muted spending on account of elections, etc. So one wants to get a sense of what kind of pickup that you've seen in the second quarter, and as a result of which, what's your outlook for the remainder of this year?
Thanks, Nigel. I'll talk a little bit about the quarter and then where the weakness came from. We had a really good quarter, actually, the highest Q1 revenue recorded at 21,335 crores. If you look at the performance outside of Arena, the subsidiary in Turkey, in India and Middle East Africa, it was a continuing story of profitable growth at 13% year on year with a PAT of 1.42%. And we had a good growth in India and in parts of MEA, 6% growth in India and 17% growth in UAE. We also saw signs of profitable growth recovery in Africa and Egypt. Parts of the things that went that could have been better and got muted a little bit was because of elections and some of the capital decision delays in India, as well as Saudi Arabia. Some of the projects got pushed out because of some government decisions. We also saw festive holidays, almost 3 weeks in Middle East Africa and Turkey. And some of these had an impact on our ability to do more. But if you look at the overall story for growth in India and Middle East Africa was good. Turkey, we had market conditions, and because of which the PC market declined in Turkey, and that caused a bit of a setback on top line and bottom line. But purely India and Middle East Africa, we had good growth trajectory, and it's only going to get better in Q2, to your question on Q2.
Right. Which is what we want to understand, Mr. Hariharan. You've spoken about all these things. You've, detailed these in your post-earnings note as well. I just wanted your thoughts on what is the kind of recovery that we will foresee from here on. I mean, for perspective, first quarter, your growth was just 0.4%. Earlier, it has been mid-teens, sometimes as high as 25-30% as well. So what's the kind of recovery? And in light of that, what's the growth that one should expect for the entire year?
So there are several factors we see in Q2. The first month has already got off to a very good start. We see the technology solutions group with the buying and the government and corporates coming back. And so we should have a good quarter on that, both in India and Middle East Africa. Similarly, on the mobility solutions, the NPIs, some have happened and some are going to happen at the end of this quarter. And we see a good pickup on that. Cloud has been growing at 35 to 40%, and that will continue to grow. And the last quarter in India, we saw PCs, consumer PCs and commercial PCs actually growing very well, and that will continue to grow. So we're quite bullish about Q2 across the geographies except Turkey. If you look at the year per se, when you talk about the year, the projection for the year from analysts is 10% growth in India and about 8 to 9% in MEA. And we're definitely not going to lose share. We're going to keep share or gain share. So we definitely have an expectation to grow at the market rate, if not faster.
Okay, all right. Hi, Mr. Hariharan. This is Nigel on this side. You briefly mentioned about cloud, and it's growing at a good rate of around 35% approximately. But currently, as a percentage of your mix, it's less than 2%. How do you see this part of your business scaling up, say in the coming year, that is FY25, and with the 3-year time horizon, how do you see that scaling up? And also for your overall margins, it's still very, very subdued. I liked how you squeezed in that bullish commentary maybe for the second quarter of this year. For the year, what kind of margin should we work with?
So let me answer the first part of the question with regards to cloud. Cloud has actually become now more than 3%. So this quarter's first time we saw between 3 and 4% of the mix. So it's definitely growing because it's growing at 35 to 40%. For this year, maybe it'll be still at 3 to 4%. And profit-wise, cloud is beginning to deliver the similar profitability levels as our overall profitability for Redington. So which is good news. It's growing with the investment we are making. The profitability is also turning in. The gross margins will come back to original levels of gross margin for the rest of the year. We had a number of factors playing in, as I mentioned before, because when the technology solutions, which is a higher margin business, once that starts coming back, our margins will rationalize. Also, the NPIs on mobility, as I mentioned, will bring up our gross margins. So our gross margins should definitely step back by at least 0.5% over where we are.
Hariharan, just a counter question. 3 to 4% of your mix is what cloud is at. But do you see it gradually move towards double digits because of the pace of growth that you're seeing there? Say by 2027, that could be the objective?
Absolutely. I think in a 2 to 3 year horizon, we think it'll get towards 8 to 10% based on our current modeling. And that's what we're hoping. And within cloud itself, currently the way we report cloud is only the hyperscaler business that we call out, but we also have a cloud business within technology solutions, which is called as software. Together, it's about $1 billion. And so that's about 10% of the overall group. So we report the infrastructure as a service, the hyperscaler business and cloud, but the others are about 700 million. If I look at it in total, it's about 10%, and we expect that to get to about 15% in 3 years.
All right. Just a final question before we let you go. Just, reworking basis what you've said so far, it appears that your revenue this year would grow between 8 to 10% and margins between 2 to 3.5%. Should we hold you on to that, at least for the full financial year?
Yeah, that's what we are gunning for. If market conditions are right, there's no reason why we will not achieve that.
All right, take that point. Thank you so much for joining in. We will obviously keep speaking with you at the end of every quarter to get an update on how business is panning out, how cloud is growing, and also what your business mix looks like going forward as well. Thank you so much for joining in. With that, let's move on. Talk about some ideas for profit coming in from our colleagues at Money Control Pro. And today we have Bharat joining in with the stock.
Today's ideas will be Royal Orchid Hotels Limited. While the demand in Q1 was affected by low business meetings due to Lok Sabha elections, heat wave, and low wedding dates, the demand has significantly picked up from the current quarter. We expect the company to deliver a healthy double-digit growth in the current fiscal. In order to tap the strong demand environment, the company has lined up aggressive room addition plans and aims to add about 1,900 keys over the next few years. This is about a 30% increase as compared to the current levels. Most of the room additions is planned via the asset-light management contract route, which is the primary business model for the company. Apart from this, the company aims to add few hotels on the revenue sharing basis and lease basis, which will provide a significant boost to the top line growth. The company will also launch 2 new sub-brands. The company is looking to enter new geographies and aims to be a pan-India hotel operator over the next few years. The hotel industry upcycle is expected to sustain over the next few years, which is beneficial for hotel operators like Royal Orchid. At the current market price, the stock is trading at an EV by EBITDA of 12 times FY26 projections. This is at a significant discount to the comparable peers like Lemon Tree and Sammy Hotels, and also at a discount to its own historical trading range. Hence, we recommend investors to add the stock in the portfolio.
Right, that is a call on Royal Orchid Hotels. We'll take a short break, come back. On the other side, we have the management of Indian Metals and Ferro Alloys, IMFA as we know it, joining in to discuss their quarter gone by.
About how much growth there is left in e-commerce in India. And hence, given Unicommerce is essentially an index to the e-commerce growth in the market, whereas shipments of e-commerce grow in India, e-commerce volumes will also grow, and Unicommerce volumes will also grow, and Unicommerce revenues will also grow, and by corollary, Unicommerce profit should also grow.
Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV18 Motilal Oswal Budget Headquarters.
Welcome back. As promised, let's focus on Indian metals and ferroalloys. That's IMFA. The company had reported margins that were much better actually on a sequential basis. On a year-on-year basis, they were more or less flattish. To understand what's the way ahead and how are things shaping up, well, we have Mr. Subrakant Panda, who is the managing director of the company. Hi, Mr. Panda. Good morning and thanks a lot for joining in. Well, let's knock out a couple of factors out of the way. The volume's a little bit lower on a year-on-year basis. Even pricing was a little bit subdued. But yet your margins came in at more than 24%. How come? And also, given that now volume should improve from here on and the benefit of higher prices will flow in, do you believe that you can hold on to margins or better it from here?
Good morning, Nigel. Always a pleasure to be on your show. So in as much as the Q1 FY25 numbers are concerned, yes, we have certainly reported better margins than we had anticipated and talked about the last time I was on air with you. But actually, in terms of prices, we have done better than the average for the previous year. If you look at it, even on a whether quarter-on-quarter basis or sequential basis, we have done better. What has also helped is the fact that input costs are have come in quite a bit lower, in the sense that both thermal coal prices have come down, as well as, more importantly, metallurgical coke prices have come down. And that is what has helped us report better numbers, even though, as you correctly said, the volume for the year was, for the quarter was a little subdued on account of maintenance activities. Now, going ahead, first of all, in our press release, what we had talked about was anticipating better prices in H2 of the current financial year. But in as much as ongoing Q2 is concerned, that is traditionally a weak quarter on account of summer vacations in Europe and monsoons in the Far East and all of that. So we are seeing a little cooling off of prices from Q1 levels, currently about 106,000 per ton or something of that sort. But the good news is that costs are coming down further. So metallurgical coke prices definitely starting from next month will come down further in terms of what we are currently using and the new inventory which is there. So all of that coupled with volumes coming back to normal should see us, if not maintain the numbers that we've reported in this quarter, perhaps even improve upon it a little bit.
So you had earlier pointed out that you could do, a rough run rate of 150 crores per quarter in terms of an EBITDA. With these developments, where do you see that number heading? And if you could give us an updated guidance on the volume, this quarter was subdued. You expect some pickup in the coming few quarters?
So volume for this quarter was roughly about 61,000 tons, as I said, on account of maintenance activities. But going ahead, we should be back to the standard 66,000 tons. So that is in terms of volume. Now, in terms of prices, what you are asking, what we expect, or EBITDA, what we expect going ahead. Look, two contradictory thoughts. As you know by now, I normally don't look too much ahead into the future, given the fact that this is an industry which is cyclical. But there is a quiet confidence that H2 will be good on account of the fact that stainless steel production has been good, whether in China, whether in India, and generally, with demand being okay and production picking up. That should translate to good times, I would say. Don't forget one other factor, which is that non-integrated producers are also sort of handicapped a little bit by high or elevated chrome ore prices. That is something which doesn't affect us, given that we have captive mines. And therefore, all these factors taken together is something that is giving me quite confidence, barring, of course, unforeseen circumstances.
Okay, all right, Mr. Panda. I was just looking at production, both from Glencore as well as Mirafis. Both of them were down by mid-teens for the first half of the year. So it clearly shows that power shortage in South Africa is clearly playing a role. Your reading?
So, funnily, actually, in as much as power situation in South Africa is concerned, that is something that has been a bit more stable than usual in the last couple of months or so. But certainly it is getting more and more challenging to produce ferrochrome in South Africa is what my general take is. You have heard a large producer indicate its intent to get out of the smelting business and only hold on to their chrome ore mining bit. So clearly, I mean, there are things happening in South Africa which are difficult to fathom sitting this far away. But there are infrastructure issues. There are many other issues which are at play, and seeing that volume correction leads me to believe that you will have more and more ferrochrome production shifting out of South Africa and moving to China, which in a way augurs well for us, because keep in mind, China is a high-cost producer on account of being being entirely dependent upon imported ore. So clearly they provide a floor to prices, and for integrated producers like ourselves, that translates into a pretty healthy EBITDA margin.
All right, so that directionally should be a positive for you, though difficult to sit here and fathom about what's taking place in South Africa. Let's talk about here and now itself. I just wanted to understand from an industry standpoint, the Supreme Court, ruling that recently came in, where it did say the power of state legislators to tax mineral-bearing lands and quarries cannot be limited by the parliament. Wanted your thoughts on this. If this were to happen, what happens next? And if not for you, for the industry, what are the kind of numbers that we're looking at?
So Mangalam, this is clearly a significant judgment that a 9-judge constitutional bench of the Supreme Court has delivered, and it has significant import going ahead. But the dust has yet to settle, in the sense, as you know, a couple of days ago there was a follow-up hearing to decide whether it would be applicable retrospectively or prospectively. So I think one has to wait and see how that pans out. So at this point in time, it's very difficult for me to comment on it. And we certainly don't have a hang of what the impact will be. So first and foremost, one needs to see whether it is going to be applicable retrospectively or prospectively, and then take it on from there.
If it is retrospective, do you have a number in mind?
No, I don't have a number in mind, but I would want to make one other point. When we talk about manufacturing competitiveness in India, a couple of things come into play. One is, of course, certainty of policies, and the second thing is the fact that if you look at minerals, they are already subject to a lot of levies. So net, one would expect that the sum total of all of this adds up to a number which is digestible. But like I said, no further comment beyond saying that let us first wait and watch whether it is retrospective or prospective and what actions follow thereafter.
All right, Mr. Panda, we let you go at that, but we look forward to having a chat with you maybe in the next coming few weeks, because the street believes that 220 crores of compensation is going to be coming to the company. So maybe once you announce plans what to do with that, we'll get you back on the channel and discuss more. Thanks a lot for joining in and giving us a fair outlook. Well, for the time being, we slip into a short break. You come back, we'll continue to focus on markets and stock-specific action.
Markets have not just grown, they've broken several records in the last 25 years. India's contribution to incremental global GDP was as low as 0.2% 25 years ago. Over the
last 25 years, CNBCTV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we're looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Welcome back. Keep an eye out on Adani Ports as well as BPCL from the Nifty pack. Both of them were down more than 2.5%. They have moved into the green. The Nifty as well has recovered close to around 60 points from the low point of the day. The Nifty Bank, that's the one that's fighting back in today's trading session. But we have run out of time on this edition of Chartbusters. You stay with us. Trading Hour comes up next.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines. 25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and cnbctv18.com.